technical session. Now I invite Coimbatore branch chairman CAS Prabhu to welcome the gathering.
Thank you, sir. Good evening, dear members. I welcome you all for this day 2 of the 8th Panchabootha Conference organized by the Tirupur, Coimbatore, Salem, Madurai and Palakkad branches and hosted by Tirupur branch. I'm happy to welcome the first technical speaker of the day, the most learned and experienced CAT Banusekar sir, who is the master professional who advises most of the tax professionals in the entire SCRC region and beyond. I'm happy that he has taken his time to address our members of the Panchabootha branches. I welcome you, sir. I take this opportunity to welcome all the members and senior members once again. And let's have a very good learning session today from our master speaker, C.A. Banusekar sir. The topic of today's discussion too is very interesting one. We usually and generally talk of tax planning and we think on the presumption that whatever we plan for the Assessees is always good tax planning. The result of it we'll come to know only when we get the notices from the income tax department and when we approach senior professionals like Banusekar sir. It is time that we understand what is a good tax planning and what is not so good tax planning, and who best can teach us this than Banusekar sir, who is always handling and solving many such issues created due to the not so good tax planning. Actually, by taking this session today, Banusekar sir is risking of losing many referrals for his future cases, but his dedication towards the professional members is more than that, and that is seen in his taking up this topic of today's discussion. I thank sir once again for addressing our members, and I am certain the session is going to be more interesting than the India-England test match that is happening. Let us have a very useful learning evening today. Thank you and welcome you all once again. Jai Hind.
Thank you, Chairman. Now I request Coimbatore branch Vice Chairman C.A. N.V. Palanisamy to formally introduce our speaker to the August audience.
Thank you, Chairman of Tirupur branch and Coimbatore branch. It's my pleasure to introduce C.A. T. Banusekar, fellow chartered accountant, to this August gathering. He is a practicing partner. He is a partner in CRPS and Associate LLB, Chartered Accountant Chennai, since 1994. He has contributed on direct tax, articles on direct tax and international taxation to several joint tax journals, including a Consolidated Commercial Digest, Taxman, Tax Repressor, and Income Tax Review. He has argued in a number of landmark cases before the various branches of Income Tax Appellate Tribunal across the country and various benches in the Income Tax Settlement Commissions. He has authored the following books: a handbook on assessment procedure under the Income Tax Act and search and seizure assessment under the Income Tax Act. Formerly visiting a faculty at Institute of Chartered Accountants of India, Institute of Company Secretaries of India, and Loyola Institute of Business Administration on direct tax. He has delivered lectures and presented papers on direct tax and international taxation at seminars, meetings, workshops, and conferences organized by ICAI, Southern India Regional Councils of Institute of Chartered Accountants of India, as well as all other regional councils of ICAI, apart from those organized by the other professional bodies and public bodies, including several branches of various regions of Institute of Chartered Accountants of India. He has actively participated trustee in brain trust session organized by the branches of ICAI. He has participated in training program for Commissioner of Income Tax conducted by the Regional Training Institute of the Income Tax Department and also Central Training Institute, that is National Academy for Direct Taxes. He has been chairman of Direct Tax Committee of Hindustan Chamber of Commerce. He is formerly columnist in the Hindu Business Line in the Personal Finance pages featured on Sunday, authoring a column in Tax Talk. He is a former member of the Southern India Regional Council of Institute of Chartered Accountants of India for the period 2001 to 2004. He is a past chairman of Physical Law Committee of Southern India Regional Council of ICAI. He was special invitee of Direct Tax Committee of ICAI and continuing professional education committee of ICAI. Presently co-opted member of Direct Tax and International Taxation Committee of SARC of ICAI. With these viewers, I am introducing today's speaker to this August participant. Over to the speaker, sir.
Thank you, Vice Chairman. Now I request our speaker, CAT Banusekar sir, to address our members. Please, sir. Sir, mute இருக்குங்க sir.
Thank you, sir. Thank you. First of all, I must express my sincere gratitude to the 5 branches. I must express my gratitude to the 5 branches for coming together and inviting me to share some of my thoughts on case laws which are against the assessee. In fact, you know, when the chairman of the Coimbatore branch was talking about the sort of topic for discussion, he said, "I'll thank the speaker for readily accepting the invitation to speak to us." But then I must first confess that what attracted me was normally the branches itself is the attraction, but this time the added attraction was the topic. I don't think anybody has ever asked me to talk on case laws in favor of the revenue or against SSC so far. In my last 25 years that I have been speaking, probably, I think this is the first time somebody is requesting me to speak on something which is against SSC. And that itself was a thrill. In fact, to be honest, I had committed to speak at another conference yesterday, which I did honor. And consequent to that, I had fixed up some programs for today. Even when this invitation came, I knew that I had programs for today, but the topic was so enticing. Honestly, the topic was so enticing that I didn't have the mind to refuse the topic, and I had to accept. So let me start with this confession to as to how I am here with all of you in this virtual conference. Now, friends, we have been going through very, very difficult times in terms of one, the pandemic, the lockdown, the slowdown of many of the industries, though of course the country seems to be still doing pretty well, because if you go by the GST collections, etc., there doesn't seem to be a big fall. And to top it all, we have a wonderful interface with the department through their website, where we can upload and download anything. In fact, I have cases where, in faceless assessment, the assessing officer is sending a notice saying, "I gave you a notice dated so and so, you have not replied. We have not received the notice, it has not been uploaded on the website, nowhere it is found." It is not even uploaded on the website. But interestingly, he says, "I have sent you a notice." Well, God save us until everything gets settled. But by the time things get settled, I don't know how many of us or how many assessees will get unsettled. As I was saying, the topic is a very, very enticing topic. I do not know whether I should call it an interesting topic, because it's also a tricky topic. It's a very tricky topic to be dealing with, but it's very enticing all the same. So what I have tried to do, friends, is to take a list of about 10 different cases where predominantly the decision has been against the assessee. And I have tried to analyze these decisions and see where the assessees could have probably bettered themselves, in terms of either a planning which could have been done better, or in certain cases, I have even taken cases where even the representation could have been improved, because I find that in some cases, the planning has been done fairly nicely. But at the representation part, there has been some lacuna, which could probably be covered up in representation and which could have been covered up. Now, how these are relevant? How are these relevant? Over the next 90 minutes of our job in hand is to discuss the various issues that have arisen as a result of about 10 decisions or so. And our endeavor will be to see how we can either present the facts better, or plan our facts better, or represent our facts better. Either we plan our facts, or present our facts, or represent our facts better. This should be the endeavor that I will be in over the next few minutes with all of you. Now, as I said, the topic itself is only with reference to case laws where the decision has gone against the assessee. And at the same time, the discussion doesn't stop with just discussing the case laws which are against the SSE, but goes a step further to discuss what could have been bettered, what could have been done well in a better manner to make the case a better case. Now, I will start with a very recent decision, sometime in 2019, a decision of the Supreme Court in a case called NRA Iron and Steel. Now, before I start, I presume that the material has already been circulated among all our friends who are there and who have joined us for this discussion. The first of these decisions that I will discuss is the decision of the Supreme Court in NRA Iron and Steel. Now, friends, it's a very dicey decision, I should say, where the issue was relating to credits under Section 68. And the issue was with regard to a company which had received share capital at a premium, a 10 rupee share capital at a premium of 190 rupees, aggregating in all to 200 rupees per share. There were in all about 19 subscribers to the share capital and aggregating to about 17.6 crores, including premium. 17.6 crores, including premium. Now, apparently, it appears that the assessment has been reopened and the assessments have been framed in a reopened assessment. Now, interestingly, I don't find much of argument or discussion in the entire order on the reopening part. It apparently appears that that part has not been agitated by the Assessee before the Supreme Court. Well, the reasons best known to the Assessee himself. Or probably the substantial question of law was not admitted by the High Court and therefore it could not be carried to Supreme Court, etc. We are not aware of those facts. But then it appears that at first sight, there is no argument that has been put forth on the reopening because it's a reopened assessment. And probably most cases, there could be a good case to make out on reopening, which does not seem to have been urged. I will probably discuss more at length on this aspect when I come to the last of the case studies that I will be discussing. Now, what happened in this case was that the assessment was reopened, and as I said, 19 subscribers had subscribed to 17.6 crores in all in the aggregate, which included share capital and premium, share capital being 10 rupees and share premium being 190 rupees, aggregating in all to 200 rupees per share. Now, during the course of the reassessment proceedings, the Assessee has apparently furnished returns of income of the companies who had invested. All the 19 subscribers were companies. The 19 companies' returns of income were filed, and evidence was given. Evidence was given to show that the transactions had happened through banking channels. Evidence was given to show that the transactions had happened through banking channels. Now, the CIT appeals and the tribunal allowed relief to the Assessee, and they held that the share capital or the amount of credits by way of share capital and premium were genuine. The matter was carried in further appeal to the High Court. In the High Court, it was an ex parte order, and the tribunal and the High Court held that no substantial question of law arose from the order of the tribunal. The matter was carried in a special leave petition to the Supreme Court, and none appeared. In fact, that was probably one of the biggest catches that probably could have happened. Representation may have helped the matter. But then it appears that none appeared for the Assessee. And the matter was finally heard ex parte by the Supreme Court as well. In fact, it was heard ex parte by the High Court, but was allowed in favor of Assessee. Or in other words, the revenues appeal got dismissed before the High Court. But before the Supreme Court, the lower authorities' orders, namely the CIT appeals, the ITAT, and the High Court's order, got reversed by the Supreme Court's order. Now, what happened? The Supreme Court, apparently, it was a case which was heard ex parte without the Assessee being present for arguments. The Supreme Court made detailed observations on the field inquiries made by the assessing officer. Now, the assessing officer in his order had made it clear that he had made substantial field inquiries and had found that the investor companies at the address given were not present at all. They were not available for receipt of any notice from the department. And he further inquired into the balance sheets of the investor company and held that there was no justification for such a huge premium paid to the investor company, with the investor company reporting a meager return of income. The investor company being a company where very meager return of income was being, very meager income was being shown in the return of income. And further, the assessee companies had invested in the range of about 90 to 95 lakhs per company. Had invested about 90 to 95 lakhs per company. Therefore, he felt that based on the decision of the Supreme Court in Sumati Dayal and Mohanakala, where he talks about the preponderance of probability, and held that the credits were bogus and added them under Section 68. Now, the Supreme Court, while analyzing the case or the issue in hand, made the following observations. Now, these observations, friends, have to be very carefully noticed, because these observations, you will notice, were made by the Supreme Court in relation to assessment year 9-10. Were made in relation to assessment year 9-10. Now, friends, you will notice that Section 68 was amended with effect from assessment year 13-14 to include share capital also to fall within the ambit of Section 68. I am not for a moment suggesting that prior to 13-14, Section 68 did not cover share capital. I am not suggesting that it did not cover share capital. It probably did cover share capital. This is an aspect that I shall come back to. But before I go to that aspect of it, now what were the observations of the Supreme Court? One, the Supreme Court said the assessee was under a legal obligation. The assessee was under a legal obligation to prove the genuineness, the identity, and the creditworthiness of the investors, and that they have a financial capacity to make the investment in question to the satisfaction of the AO. They went on to say the AO is duty bound to investigate the creditworthiness of the creditors or subscribers, to verify the identity of subscribers and ascertain whether the transaction was genuine. Third, they said if the inquiries and investigations reveal that the identity of the creditors is dubious or doubtful or lack creditworthiness, then the genuineness of the transaction would not be established. And then they said in such a case, the onus cast on the assessee under Section 68 would not be discharged, and that therefore an addition could be made. The Supreme Court also made further observations on the field inquiry conducted by the assessing officer and said there was no material on record to prove or suggest that the share application money was received from independent legal entities. In fact, the investigation conducted by the officer only demonstrated that the investor companies were non-existent. Next, they went on to say that the investor companies had filed returns of income with negligible income, and that therefore they were not in a position to invest this kind of monies into the company, which is the respondent before the Supreme Court. Next, they said there was no justification for the very high premium that had been brought in by the investors in this case. They also said that the investors had not established the source of funds for such high premium, and that mere citing of the PAN number or the file number would not suffice for the purpose of holding that the credit was genuine. For the purpose of holding the credit was genuine. Mere citing of the PAN was not enough. At this stage, let me pause and look at some of the earlier decisions in this context. You have at least 3 decisions of the Supreme Court. One in a case called Stellar Investments, which is reported in 251 ITR 263. I repeat, 251 ITR 263, Stellar Investment. You also have a decision of the Delhi High Court, which has been affirmed by Supreme Court in Divine Leasing and Finance. Divine Leasing and Finance is not reported in ITR. The Supreme Court is not reported in ITR. It is reported in Tax Management India in 2008 as number 927. The Delhi High Court, which got affirmed, is reported in 299 ITR 268. You also have a third decision, which is probably, to my mind, the most important of these. The decision of the case in the case of Lovely Exports Private Limited, which again is reported in 6 DTR 308, the Supreme Court, and the Delhi High Court being in 299 ITR 268. Now, why did I say Lovely Export is most important to me? Because Lovely Exports, specifically the name itself says Lovely Exports Private Limited. Whereas the other two companies are Divine Leasing and Finance Limited and Stellar Investment Limited. Honestly, I am not aware whether these are widely held companies or closely held companies. But then for sure, Lovely Exports Private Limited is a closely held company. Now, what was the decision of the Delhi High Court which got affirmed by the Supreme Court? The Delhi High Court had held that so long as the assessee is able to demonstrate the identity and the genuineness, the identity of the payer and the genuineness of the transaction, it was beyond his requirement for the purpose of establishing that share capital should not be added under 68. It was beyond the requirements of Section 68 that he should demonstrate the creditworthiness of the subscriber. Now, this decision was rendered in the context of Section 68, in the context of share capital, prior to assessment year 13-14 when the amendment was made. Please note that for and from assessment year 13-14, creditworthiness will also have to be demonstrated if it is a closely held company. If it is a widely held company, well, the creditworthiness does not have to be demonstrated, but all the same, identity and genuineness of the transaction will have to be demonstrated in every case. Now, having said this, now if we go back to the decision of Supreme Court in the case in hand, which we were just discussing, NRA Iron and Steel, the Supreme Court seems to have said that you have not established the creditworthiness of the investors. But then if you read the decision more carefully, apparently the assessee has not merely not established the creditworthiness of the investors, but has failed to establish the identity or the genuineness of the transaction. Identity, because they say mere furnishing of PAN is not enough when the investor company itself are not even present in the address that you are giving. After all, if you have taken share capital, you are going to declare dividend, pay dividend, etc. when as and when you make profits. So you will have the latest address in all probability. Two, you are not able to show that the transaction is genuine because one, you are showing a very low profit or income in your return of income. But at the same time, somebody is investing at a huge premium without any reason. So the genuineness of the transaction is also not true. It was probably in this background that the Supreme Court went on to look into the creditworthiness also and found that even that is not being established. But subject to that aspect, I would think that if the assessee is prior to assessment year 13-14, that up to assessment year 12-13, in respect of share capital, if an assessee could have at least demonstrated the identity of the investor as also the fact of genuineness of the transaction, probably the court might have taken a more lenient. But while this is said, I would think it is very important for an assessee hereafter, after we see this decision of the Supreme Court in NRA Iron and Steel, to be very, very careful to ensure that every evidence is kept in the possession of the assessee, to ensure that we not only are able to demonstrate the identity and the genuineness of the transaction, but also are able to establish the creditworthiness of the investor. So for each and every one of these, genuineness of the transaction, creditworthiness of the investor, and identity of the investor, all three of these, proper evidences should be kept and furnished. Right? So this is a very important decision of Supreme Court, which can have large-scale ramifications. Kindly note, friends, that with effect from assessment year 13-14, we are in a situation where we will have to not merely establish identity and genuineness, but also creditworthiness of the parties who are investors, and therefore that becomes important. Of course, if you are a widely held company, not a closely held company, then this will not apply. This is the first decision I thought I will discuss. Now, the second is a set of decisions, not one decision. I'm going to discuss about 4 decisions. Three of them were against Assessee, 1 in favor of us. Now, the 1 in favor of Assessee has some observations which are very significant for understanding why the 3 decisions are relevant still. The decisions against Assessee are relevant still. Now, the first of these decisions is the decision of Supreme Court in TV Sundaramayangar and Sons. Now, the facts of the case were like this. The Assessee had received deposits in the course of business which were originally treated as capital receipts. These deposits were not claimed or returned to the depositors. They were not claimed or returned to the depositors. The deposits were in the course of carrying on business of the Assessee, and the amounts were not in the nature of security, were not in the nature of security deposits held for performance of contracts, but got adjusted or depleted against various transactions that happened from time to time. Now, the deposits were taken in the course of trade and adjustments were made against these deposits in the course of trade. The Assessee also wrote back these deposits in the P&L account as not being any longer payable. He wrote it back as an unclaimed surplus. Now, before, at that time, you will recall that writing back was not a criterion for an income to be brought under 41(1), and even if there was a write back, it is not necessary that it should have been brought to tax under 41(1). Now, the Assessee's argument was predominantly that when it was received, the sums were received in the course of the business, but were in the nature of capital receipt, because these were deposits. And subsequently, when it was written back, the capital receipts continued to remain in the capital field, and that therefore the Assessee claimed that it could not be treated as income of the Assessee. It could not be treated as income of the Assessee. The Supreme Court went on to analyze the facts of the case and said that since these deposits were taken in the course of trade, and since these deposits were not given for the purpose of performance of a contract, but were adjusted from time to time, like any other rental advance, etc., which could be adjusted against rent payable. They said that when this becomes not payable, common sense demands that the amount should be treated as income. And they went on to say that the claims of the customers have already become barred by limitation, A, and B, that the Assessee itself had treated it as its own monies by crediting the P&L account. By crediting the P&L account, the Assessee had treated it as its own monies. And therefore, the Supreme Court went on to hold that it was in the nature of a revenue receipt which was exigible to tax in the year in which the write back happened. Now, the second of these decisions is the decision of the Bombay High Court in a case called Solid Containers. A case called Solid Containers. Sorry, just give me a moment. Yes. The Bombay High Court in Solid Containers. Now, here it was the case of the Assessee that a loan which was a capital receipt, and which was subsequently waived, could not be treated as income of the Assessee. It was subsequently waived and could not be treated as income of the Assessee. because according to him, the loan when it was received was a capital receipt. And for this proposition, the assessee relied on the decision of the Bombay High Court in Mahindra and Mahindra Limited. The assessee relied on Mahindra and Mahindra Limited. Now, the Bombay High Court went on to analyze the decision of the Bombay High Court in Mahindra and Mahindra Limited and ultimately took a view against the assessee. That is a contrary view to the view taken in Mahindra and Mahindra Limited by distinguishing the matter on facts. By distinguishing the matter on facts. What they found was that in Mahindra and Mahindra Limited, the loan was taken for the purpose of acquiring capital assets. The loan was taken for the purpose of acquiring capital assets, and therefore, according to the Bombay High Court, in solid containers, since the present loan was not taken for the purpose of acquiring capital assets, but in a normal course for carrying on the business, that is for working capital requirements, the decision in Mahindra and Mahindra, according to them, would be of no help. And they ultimately held against assessee, holding that it would be a revenue receipt which would be exigible to tax. The third of these is a very interesting decision of the Madras High Court in a case called Ramaniam Homes. Now, this was a case where the revenue took a stand that there was a loan taken by the assessee from Indian Bank on which there was a one-time settlement. And a part of the loan was waived by Indian Bank. So it was the claim of the assessee that since it was in the capital field, it was not chargeable to tax, and again, reliance was placed in Mahindra and Mahindra, the Bombay High Court. Now, note very carefully, the Madras High Court made two observations. One, they said that this can come within the ambit of 28(4) of the Income Tax Act. 28(4) provides that the value of any benefit or perquisite, whether convertible into money or not, arising from a business or exercise of profession, will be treated as income and chargeable as profits and gains of business. The value of any benefit or perquisite. One of the arguments of the assessee was that the language used is the value of benefit or perquisite. Therefore, money per se will not fall within the ambit of section 28(4). The Madras High Court negatived this contention and said it makes little difference whether it is money or benefit or perquisite. The language of 28(4) can cover money also, was the observation of Supreme Court. I will take this with a pinch of salt because this observation of the Madras High Court has since not been approved by the Supreme Court. I'll come to the Supreme Court. And they also went on to say that since there is no distinction between the purpose for which the loan was taken, and it will fall within the ambit of income. In fact, it's a very surprising decision because the Supreme Court went on to say that the decision of another division bench in the Madras High Court in a case called Iskramico region was an incorrect decision. And somewhere the Madras High Court seems to have gone into saying that this will become income under the double entry system. The assessees are not permitted to follow single entry system. I really would not understand whether it is double entry or single entry, etc. was probably not at all relevant, but the Supreme Court goes into that aspect as well. And apparently, I don't think Ramaniam builders would have followed the single entry system or anything like that. It is impossible. Being a company, following the single entry would have been impermissible. So, end of day, they said that waiver of a loan will always be treated as income. Whether it is a loan taken for the purpose of acquiring capital assets or whether it is a loan taken for working capital requirements, it would be treated as income, was the decision of the Madras High Court. Then you have a decision of the Supreme Court which affirms the decision of the Bombay High Court in Mahindra and Mahindra Limited. Now, I have already stated the facts very briefly. Just to recapitulate, loans were taken for the purpose of acquiring capital assets by Mahindra and Mahindra Limited, and these loans were waived subsequently. The revenue took a stand that this could be brought to tax under section 28(4) or otherwise under 41(1). Insofar as 28(4) is concerned, the Supreme Court negatived the contention of the revenue and held that 28(4) will only cover a case of benefit or perquisite and not money. You will notice that Ramaniyam Builders, the Madras High Court had held that money is also covered. That observation now stands reversed by this decision of the Supreme Court in Mahindra and Mahindra, which affirms the Bombay High Court in Mahindra and Mahindra. Okay. Now, whether this will fall under the ambit of 41(1), the Supreme Court held on facts that it will not fall within the ambit of 41(1). It will not fall within the ambit of 41(1). Was the observation of the Supreme Court. But then, if you see the decision a little carefully, it says the purchase of plant and machinery, was not debited to the trading or P&L account in any of the assessment years. Was not debited to the P&L account or trading account in any of the assessment years, and therefore the Supreme Court held that 41(1) is not attracted. In fact, the Supreme Court also went on to analyze, because one of the arguments of the revenue was that depreciation has been claimed, so therefore the cost of the asset has been debited to P&L account. The Supreme Court negatived that contention also and said, no, that cannot be a correct proposition. Depreciation is for wear and tear of the asset. It is not a debit of the cost of the asset. It is a separate debit towards wear and tear of the asset. And ultimately held that neither 28(4) nor 41(1) was invocable in the facts of the case, but observed that 41(1) was not invocable. 41(1) was not invocable because there was no debit of any expense which was incurred out of the loan taken. The purchase of the asset was not debited to P&L. So, by corollary, I will understand that if the loan was taken for working capital requirements and, say for example, used to pay creditors for purchases, not repay loan creditors, but purchase creditors were paid out of a loan taken. Apparently, purchases are made that would have been debited to the P&L account, and therefore, one could understand that the observations of the Supreme Court may go against assessee if the loan was taken for the purpose of working capital requirements. Now, where is the scope for planning here? It is important that we maintain proper records to demonstrate how the loan was in fact utilized. Because what happens more often than not is we have fungible funds. We do not know which money is spent where. Particularly if you are taking a term loan from a bank, there will be no problem. But if you are taking loans from private parties which get waived, from parent company, from sister concerns which get waived, you may not have proper records of the purpose for which the loan was taken or utilized. So in order to ensure that we are able to get ourselves outside the ambit of 41(1), we need to ensure that we keep adequate data and plan our affairs properly to ensure that we are able to demonstrate that the loan was in fact taken and utilized for acquiring capital assets which have not been debited to P&L account. If we can demonstrate that on facts, then 41(1) is not invocable. 28(4), of course, money is not covered, is the observation of Supreme Court in Mahindra and Mahindra Limited, and therefore we would be outside the ambit of 28(4). So one needs to be very careful about the application of 41(1). The third decision is a decision of the Madras High Court in a case called West Asia Exports and Imports Private Limited. This again is a very, very important decision on the invocation of section 41(1). Now, here was a case where the assessee was engaged in timber business originally, and then he switched his business, closed the timber business, switched his business, and moved to recruitment of employees for sending to Gulf countries on behalf of foreign companies. There were some creditors which were related to the timber business, and the assessee claimed that these were creditors which were still outstanding, while the assessing officer brought this to tax under 41(1). Now, what were the arguments of the assessee? The assessee's first submission was that this had not been written off or written back, I should say. Two, the assessee's submission was that under 18 of the Limitation Act, under Section 18 of the Limitation Act, the loan is not barred by limitation because I am still showing it as outstanding. Section 18 of the Limitation Act would say that if you acknowledge a debt in any manner, the debt limitation will start from that date. So in your balance sheet, if I show you as a creditor, I am acknowledging the debt in my balance sheet. And since I am acknowledging the debt, the loan will still be freshly due from that day. The limitation period will run from that day. They argued that Section 18, it is not barred by limitation, because you will recall that Supreme Court in TV Sundaramayangar and Sons and said that the loans were barred by limitation. The amounts were barred by limitation. Thirdly, the RC argued that no cessation of liability had actually happened. The Supreme Court, the Madras High Court, held against assessee and said, one, these were liabilities relating to an erstwhile business of the assessee, not to a business which is presently continuing and being carried on. And that business was discontinued more than 10 years back. A. B, it said the assessing officer has drawn a conclusion that it has become barred by limitation. It has not become barred by limitation, but in fact, no creditor has come forward to make any claim on the assessee, and that therefore, though it is not barred by limitation, by inference, the liability has ceased to exist. So the factum of change of business, the factum that no creditor has made any claim on the assessee in the last 10 years was also significant. Then they went on to say that merely because you have not written it back, it will not be appropriate to say that 41(1) is not invocable. They said that so long as there is a cessation of liability, the entries in the books of account will not be relevant. And they also went on to observe that the assessee did not produce any confirmations despite the same being called for by the assessing officer during the course of assessment proceedings. They said if we take a view that this will not be covered by 41(1), then it would defeat the very object of 41(1), and went on to hold that the credits were in fact to be treated as income of the assessee under 41(1). So what can we do? One, the non-production of confirmation letters was one aspect. Probably one could consider the filing of confirmation letters if and when required, so that we are able to say that the creditors have not ceased to exist. Likewise, one argument that I find absent is why should it be treated as the income of this year? Now, 41(1) talks of a cessation of liability. I agree, if there is a cessation of liability, it should be income. And probably the facts of this case would demonstrate that there is a cessation of liability. But in which year is it taxable? It is not that the assessing officer can choose any year to tax it in that year. The assessing officer has to offer it or has to tax it, bring it to tax in the year in which there is a cessation. There is nothing on record to demonstrate in the facts of the present case that the cessation happened in the current previous year. That is, in the impugned year, the cessation happened. Well, it would have been in the fitness of things to urge that the cessation, if at all, has not been demonstrated to happen in the impugned year, and that therefore it cannot be brought to tax in the impugned year. But such an argument is found absent. The one other thing that probably we could think, it may depend on facts, is that if you think there is a cessation of liability and that 41(1) could be invoked, you remember that we have a choice. Because presently 41(1) says, if you write back, it will be treated as income. So you have the choice. Supposing in some year you find that you have a loss, you write back in that year, so that there will be probably no tax implication that year, right? That could be one way in which one could think of planning affairs. And there is absolutely nothing wrong about it. It is absolutely legal to bring it to the credit of the P&L account in any year in which the SC does so, it will be treated as income under section 41(1). That could be another area where the SC could have probably planned his affairs a little better. Particularly given the fact that the SC in this case closed a business and opened a fresh business. In my view, he would have been incurring losses. That is why he would have closed one line of activity. If it is a good profitable business, he would not have closed that line of activity. So in the years when he had closed that line of activity because he had incurred losses, he could have chosen to write back. That may have helped. The next is again a decision of the Madras High Court in a case called ETA Travel Agency Private Limited. This again is a very, I should say, dangerous decision. If not analyzed very carefully, it can be a very dangerous decision which has come from the Madras High Court. Now, what were the facts of this case? The basic issue was whether expenditure incurred on renovation and leased premises is revenue or capital expenditure. Is revenue or capital expenditure. Now, what had happened in this case was that the assessee had taken a premises on lease and had incurred various expenditure which were in the nature of fixing doors, both wooden as well as aluminium, collapsible shutters, mirrors, partitions, false ceiling, and providing various types of furniture to executives and for functions. The CIT appeal examined the floor-wise breakup of expenditure, sampled the various types of work, and went on to say, look at the electrical work that was carried out, and ultimately said that no capital asset had been created and that there was no enduring benefit. The decisional CIT appeal ultimately came to be reversed by the High Court. The High Court observed that the assessee had spent substantial funds. The assessee had spent substantial funds in creating office space with a particular design to suit their requirement. The assessee had been appointed as an agent of Malaysian Airlines. He had been appointed as an agent of Malaysian Airlines, and to suit the requirements of Malaysian Airlines to be their agent, he had incurred certain expenditure. The expenditure A, they said, was huge, and they said that the expenditure is shown to be fixed in nature, and that the assessee cannot remove the same at the time of vacating the premises. The Madras High Court went on to say that this can be an incorrect test, and went on to look at the explanation 1 to section 32(1). Explanation 1 to 32(1) reads like this. It says that where the business or profession of an assessee is carried on in a building not owned by him, which carried on in a building not owned by him, but in respect of which the assessee holds a lease or other right of occupancy, and any capital expenditure is incurred by the assessee for the purpose of the business or profession on construction of any structure or doing of any work. It said construction of any structure or doing of any work in relation to, or by way of renovation or extension of or improvement to the building, then the provisions of this clause shall apply as if the said structure or work is a building owned by the assessee, which means the assessee would be entitled only to depreciation by virtue of the provisions of 32(1). Now, the Madras High Court went on to analyze the facts and ultimately said that this can only be a case where depreciation can be claimed under 32(1). Now, what could have been bettered by the assessor? A, he could have shown that he could have distinguished the expenditure between expenditure in the capital field and expenditure in the revenue field. Because if you see, they are talking about fixing doors, aluminium, collapsible shutters, mirrors, partitions, etc., false ceiling, etc. Now, for example, false ceiling, mirror, predominantly false ceiling, I will say, they cannot be removed at all. They have to be left in an as-is whereas condition. So he could have probably distinguished between what could be treated as revenue expenditure and what could be treated as capital expenditure. And if he had made such a distinction, probably he would have got revenue expenditure allowed and the capital expenditure depreciation would have been allowed. But unfortunately, everything went into one basket. The assessee claiming the whole of it as capital expenditure, everything went into one basket. And therefore, ultimately, the Madras High Court held that the entire expenditure was in the capital field and only depreciation was allowed. In fact, there is one interesting decision of the Kerala High Court. It is reported as 382 ITR 503, the Kerala High Court in a case called Indus Motors Company Private Limited. 382 ITR 503, which citation is there in the paper that I have circulated. Okay. Now, there is a very interesting observation of the Kerala. What does it say? The explanation to 32(1) is only meant that in the event of capital expenditure being incurred by the assessee, the provisions of 32(1) shall be applicable as though the structure or building or work is a building owned by the assessee, and ultimately went on to hold that one has to examine on a case-to-case basis whether the expenditure is in the nature of capital expenditure. It is not every expenditure incurred on a leased premises which can be treated as capital expenditure and depreciation allowed. If it is in the nature of capital expenditure, then depreciation will be allowed. If it is in the nature of revenue expenditure, then it will be allowed under 37(1) itself. So this observation of Kerala High Court is very important, and I think the assessee would have done well to take alternate plea saying that at least these expenditures should be allowed, where there is probably no enduring benefit and where there is no capital expenditure. At this stage, I will just draw your attention to one very interesting decision of the Madras High Court, again reported in 293 ITR 432. The decision of the Madras High Court in 293 ITR 432 in the name of CIT versus TVS Lean Logistics Limited. That was a case where land was taken on lease and a superstructure was built on the land. And the issue was whether it was hit by the explanation 32(1). Now, even prior to this decision, there is a decision of the Supreme Court in a case called Madras Auto Service, reported in 233 ITR 468, 233 ITR 468, Madras Auto Service, where the Supreme Court held that constructing a superstructure on leased premises is not a capital expenditure and is allowable under 37(1). It was after Madras Auto Service came that the explanation to 32(1) was inserted. Explanation 1 to 32(1) was inserted. Explanation 1 to 32(1) says if a land and building is taken on lease, if you read the language of explanation to 32(1), it says where the business or profession of the assessee is carried on in a building which is not owned by him, but in respect of which the assessee holds a lease. So the lease should be of the building. The Madras High Court said, even after the insertion of explanation 32(1), if the land is only taken on lease and building is not taken on lease, any cost incurred to put up the superstructure will be allowable under 37(1). So we are now in a very tricky situation. If you take a land on lease and put up a whole superstructure, 37(1). If you take a land and building on lease and do some work, either by way of addition to the superstructure or by way of renovations in any manner to the superstructure, then if it is in a capital expenditure field, then only depreciation would be allowable, can be the view taken. But as I said, good planning could have been done by distinguishing between what could be capital and what could be revenue expenditure, instead of merely taking a global plea that all of it was capital expenditure. At least an alternate plea in that regard would have helped the assessor. The fifth of the decisions is the decision of the Mumbai bench of the tribunal in a case called Sumit Securities. It's a special bench decision. Now, this was a decision rendered in the context of Section 50B of the Income Tax Act. Now, this is very significant because of the amendment that has been made in 50B, and also because of certain amendments that have been made in 2021 by insertion of Section 9B and by amendment to Section 45(4) of the Income Tax Act. To put it very simply, the issue was that of how to compute capital gains in case of a slump sale. Now, basically, if you look at Section 50B as it stood prior to the amendment made to the Finance Act 2021, it said when there is a slump sale, the undertaking as a whole will be regarded as a capital asset. And the net worth of the undertaking will be deemed to be the cost of the undertaking. Will be the cost of acquisition of the undertaking. The net worth will be the cost of acquisition of the undertaking. Now, what happened in this case was that the assessee's claim was that the net worth of the undertaking was negative. And therefore, according to him, the negative net worth must be taken as nil. See, what happens is you take a full value of consideration, subtract the cost. Now, the cost is the net worth. If the net worth is positive, that amount will go to reduce the capital gain. That amount will go to reduce the capital gain. A. Now, if the net worth is negative, and if you take the net worth, since it is negative, if you take the cost to be nil, your capital gain will be equal to the net consideration or the full value of consideration, let's say. Now, assuming that you take the negative figure and add it to the consideration, your capital gains will increase. Now, the assessee's contention was that the negative net worth must be ignored, or in other words, should be taken as nil. The revenue's contention was that the negative net worth should be continued to be taken into account for the purpose of computing capital gain. The matter was referred to the special bench, and the special bench took a view against the assessee. The special bench of the tribunal took a view against the assessee and said negative net worth cannot be ignored. Negative net worth cannot be ignored, and went on to hold that the cost of acquisition can be negative also. Right? Can be, negative also. I would think logically that should not have happened. But then they went on to explain that if you are not going to take it as part of cost of acquisition, then that was a liability attached to the assets that you are taking over. And therefore, consequently, you will have to look at it as going to add to the consideration, and thus should anyway be treated as part of income of the assessee under 50. The Madras High Court, the full bench of the tribunal took a view against assessee. One of the arguments of the SC, which can be very favorable to this part of the country, is the decision of the Supreme Court in IPCA Laboratories, where the assessee argued that the negative figure should be ignored, because in IPCA Laboratories, Supreme Court said if your first limb is negative, you don't get 80 HSC at all. That was one of the arguments of this. The special bench, the Mumbai special bench, negative this contention also, and said that in IPCA Laboratories was case of deduction, where if it is negative, you know, the deduction is not available because you have not made a profit from your export business. But that is not the case here. Here is a case we are going to treat something as income, and therefore the principle laid down in IPCA will not apply. And therefore, ultimately held that the negative net worth must be added to the net consideration, and the entire amount would get charged to tax, including the negative net worth. Now, friends, this becomes also crucial. This argument can work against assessee. In fact, it is even more dangerous now to take this view because of the amendment made in the by the Finance Act 2021. Now, by the Finance Act 2021, they have brought in Section 9B and amended Section 45(4) of the Act. They have amended Section 45(4) and inserted a new Section 9B. 9B is applicable in case of dissolution or retire or on reconstitution of a firm in AOP or UI. And 45(4) is applicable on reconstitution of a firm AOP or UI. 9B seeks to tax if an asset or stock in trade is distributed to a partner or a member of the AOP or UI on dissolution or on reconstitution. It seeks to tax the fair market value minus the cost, or as the case may be, the indexed cost in the hands of the firm as capital gain. Section 45(4) provides that if a partner is receiving any amount in excess of the balance standing to his capital account, then that excess amount will be charged as capital gain in the hands of the partnership firm. And for this, they have a formula in 45(4). 45(4) says A is equal to B plus C minus D. A is equal to B plus C minus D, A being the capital gain, B being the value of money received, C being the fair market value of assets that are given to the partner on such reconstitution, and D being the balance in his capital account. Right? So A is equal to B plus C minus D is the formula used. And if you see 45(4), it very clearly provides that if A turns to be negative, it will be ignored. If A turns out to be negative, it will be ignored. Now, this argument that negative net worth should be left out in the context of 50B, though there is no express provision, takes a further setback with this amendment. Now, without this amendment, probably you could have tried at higher fora with regard to whether negative should be ignored or not. But then now, if I were arguing for revenue, I will say that you look at 45(4), express provisions are made whenever the tax authorities wanted negative to be ignored. Whenever the parliament in its wisdom, the legislature in its wisdom wanted negative to be ignored, they have made express provisions like in 45(4). same is absent in 50B, and therefore negative net worth cannot be ignored, but has to be only included and consequently has to be part of the amount that will get charged to capital gains tax. Now, friends, I will not discuss more on 45.4 and 9B. In fact, I was saying even as I started that yesterday I had a session with some other branch, and that was on 45.4 with 9B. And in fact, after I read 45.4 and 9B, I should say that there was a huge amount of issues that arose. The sections are so peculiarly drafted. I won't say badly drafted, well drafted, nothing. But they are so peculiarly drafted. The kind of thought process that has gone into drafting it to some extent is also a little sadistic. But then that is not my subject matter of discussion. The subject matter of discussion is restricted to the decision of the special bench in Sumit, where the special bench held that negative net worth should be ignored. I think that is going to be a very indefensible plea in future. It's going to be less and less possible to defend this. So it may be advisable to ensure that we pay adequate advance taxes so that we are not hauled up tomorrow to pay this along with the tax and interest, and probably a penalty also. The next or the sixth issue is with regard to when there is an allowability of expenditure on setting up of business or commencement of business. Now, this was a case where the company was incorporated on 30th of March 2012 and was carrying on business of manufacturing and more of mold handling lines and shot blasting machines. The SC had claimed various expenditure for assessment year 13-14, but had not admitted any income from business operations. The SC stated that he had already commenced his business by setting up an infrastructure by way of building and fixed assets, and which he had capitalized. But he had also placed orders for machinery to manufacture, and that therefore, according to him, he had commenced his business. Right? Therefore, according to him, he had commenced his business. Now, the assessing officer said that the assessee had placed purchase orders for the designs and drawings only on 10/10/2012, that is in October 2012, the previous year being 12-13, relevant to assessment year 13-14. And these were due for delivery only on 28/2013. That is in the next year. That is in the previous year 13-14, relevant to assessment year 14-15. Right? Relevant to assessment year 14-15. Right? So, according to the assessing officer, there had been no commencement of business, and therefore the expenditure, according to him, was not allowable. The CIT appeal also held against the SC, and the matter travelled to the Chennai tribunal. Before the Chennai tribunal, the SC placed reliance on the fact that he had already placed orders for procurement of plant and machinery. He had placed orders for procurement of plant and machinery, and he had already started paying technicians and other expenses who were staff involved in the execution of the placing of orders, etc. So, according to him, he had a right to claim the expenditure in respect of the business that had, according to him, already commenced. That had already commenced. Now, what was the view of the tribunal? The tribunal went on to say that it is not necessary that in each and every case, revenue should have been generated for the assessee to say that business has commenced. But on facts, they went on to hold that in the case in hand, business could not be said to have been commenced, because you have only placed an order for designs and drawings, which also is due only in the next previous year. That is not in the impugned year, but in the next year. So whatever expenses you are incurring now should be capitalized and should only be claimed over a period of time by way of depreciation and cannot be allowed as revenue expenditure. They went on to say that the SC has not even set up the plant and machinery required for manufacturing the goods or articles, and therefore it was evident that the SC cannot be said to have commenced business in the previous year. They went on to make it very, very clear that it is not necessary that revenue should be derived. In fact, though not directly in this context, you have another decision of the Chennai tribunal, which I myself had the luxury of arguing, where the issue was with regard to the allowability of depreciation on an asset, on a few assets. Now, the assessing officer denied depreciation, saying that the installation itself happened only on 31st March of the previous year. Therefore, it is impossible that the asset could have been put to use in the previous year. Right? The installation of the assets itself happened only on 30th of March or 30th of March of the previous year. Therefore, it could not have been put to use in the previous year and disallowed the depreciation. Of course, we did argue that it was put to use, but apart from that, we took an alternate plea saying that even assuming it has not been put to use, it was ready for use. The tribunal found favor with the alternate arguments. They did not adjudicate on the main prayer at all. They said on the alternate prayer made itself, we find that the assessing officer has come to the conclusion that the assets are installed and ready for use. The fact that they are ready for use is enough for us to allow the claim of depreciation. So what needs to be done is to ensure that we can demonstrate that the business is ready to commence, at least in every manner, or at least partially ready to commence. Even if it is commenced in a very minuscule manner, very small amounts of business have commenced, revenue need not have come in. Revenue need not have come in. Now, in fact, whenever I used to teach long back, I used to tell the children then that there is only a readiness of the business which is required for allowability of expenditure. For example, a chartered accountant starts his profession today. Up to 31st March, he does not get a single client, let us say, or a single rupee fee. Does it matter? No. He is ready to deliver if and when the client comes. That is enough. He has commenced his profession. Now, same way in business, if one can demonstrate that he has in fact commenced his business, that will probably cleanse the whole issue and the expenditure would have got allowed. The expenditure would have got allowed under 37(1), or if it is interest under 36(1)(3). This aspect has probably to be demonstrated on facts, and therefore one has to maintain proper and pakka records to show that business has in fact commenced, rather than bald statements saying I have placed orders, etc. He could have, if somebody can demonstrate that they have made some trial, they have participated in fairs for getting business, etc., then yes, maybe the case could have gone on a different line. The next again is a very peculiar decision of the Bangalore bench of the tribunal. It is the Bangalore bench of the tribunal in a case called 2M Power Health Management Services Private Limited. 2M Power Health Management Services Private Limited. Now, this was a case where the assessee allotted 36,000 compulsorily convertible cumulative preference shares at a premium of 490 rupees per share to 7 different parties. They obtained a valuation report from a chartered accountant, and the chartered accountant followed the DCF method of valuation of shares and certified that based on future cash flows, the premium was justified. The assessing officer held that as per Rule 11 UA 2A, the fair market value of the asset was only rupees 56 And since the premium received was 490 per share, he added the differential amount as income. Now, before the tribunal, the assessee's contention was that the valuation report was based on several factors like the future business plans, the expansion plans, the industry, the economic scenario, the customer sentiments prevalent at the time of drawing up the business, etc. And these cannot be compared with the actuals. Two, he said, they argued that the assessee has an option to choose the valuation methodology for unquoted shares under the methods that are stipulated in 11 UA 2A of the rules or 11 UA 2B of the rules. And then ultimately went on to contend that for unquoted preference shares, what was applicable was clause C. And if at all, we should have taken what could have been taken only under clause C. Now, ultimately, in this case, the tribunal remitted the matter back to the file of the assessing officer with certain observations and said that first thing that the assessing officer must examine is whether these should be treated as equity shares or preference shares. Because they went on to observe that there is a very marginal difference between an equity share and a preference share in so much as in an equity share, there is a voting power, but in a preference share, the voting power is a restricted voting power. But subject to that, they said preference shares are almost on par with equity shares. The SC had placed certain fresh facts, before the tribunal. Right? And therefore, the matter was remitted. And they said, you find out whether this is in the nature of equity, though it is called a preference share. You examine whether it is in the nature of equity. And then decide accordingly. Now, this is technically not a decision which went against assessee, but several observations in this case went against the assessee. Now, if one were to look at Rule 11 UA, Rule 11 UA has subrule 1 and subrule 2. Subrule 1 deals with section 56. And subrule 2 says, notwithstanding anything contained in subrule 1, for the purpose of 5627B, subrule 2 will apply. So, if the matter is concerning 5627B, subrule 2 will apply, not subrule 1. First of all, I fail to understand why there were substantial arguments, brought on subrule 1. Subrule 2 is what is applicable, because the whole issue was that there was issue of shares at a premium, and according to the assessing officer, since the premium was not justified, the excess over what could be the reasonable premium should be brought to tax under 5627B in the hands of the company. Subrule 2 is what should have applied. So subrule 1 was of no relevance at all in the facts and circumstances of the case. Now in subrule 2, what happens? In subrule 2, the assessee has an option. I'm making it very clear. The assessee has an option. Option A, he has to go by what would be the book value of assets. Right? What would be the book value of assets? Where is option A? And option B is to take the discounted cash flow. Method and to arrive at the value of premium that could be taken into account. Now, if one were to go into 5627B, in section 5627B, it says, where a company in which the public are not substantially interested receives any sum exceeding face value, then if such excess is more than the fair market value, there will be an income which is chargeable to tax in the hands of the company. And there they say, fair market value means the fair market value as determined in accordance with the method prescribed, or as may be substantiated by the company to the satisfaction of the assessing officer based on the value of on the date of issue of shares of assets, including intangible assets being goodwill, know-how, patents, copyrights, trademarks, licenses, franchises, or any other business or commercial rights of similar nature. So now if one reads 5627B along with Rule 11UA, one will understand this. A, I have an option to either go by Rule 11UA2 or to go by a value which I can substantiate before the assessing officer. First, that option is available to me because it says whichever is higher. So obviously, when you say whichever is higher, every assessee will choose what is higher to him only. So I will now first have an option to choose between Rule 11UA2 and the value that I can substantiate. This is A. The second aspect is that we have Rule 11UA, which gives an option to the assessee, which says either go by the book value of assets that are there in the books, or you go by the DCF method. So I, as an assessee, have now different options. A, I could have gone by what I can substantiate if it is higher than Rule 11UA. B, if I'm not able to substantiate like what is provided for in section 5627B, I can go to Rule 11UA and choose the higher of the two. Right? Now, in this, there is one very important aspect that one has to bear in mind. If one looks at Ind AS 32 to be more specific, you will see that Ind AS 32 talks about certain kinds of disclosures in the balance sheet. And if you see Ind AS 2, it says the substance of a financial instrument rather than the legal form governs its classification in the entity's balance sheet. Substance and legal form are commonly consistent, but not always. Since financial instruments take a legal form of equity, but are liabilities in substance, others may combine features associated with equity instruments and features associated with financial liabilities, and then proceeds after some time to say that certain other investments or certain other instruments can also take the form of equity if one were to look at the substance over the form. And then they give an example. They say example of equity instruments includes non-puttable ordinary shares, some puttable instruments, some instruments that impose on the entity an obligation to deliver to another party a pro rata share of the net assets of the entity only on liquidation, some types of preference shares, and then goes on to say that is provided for in later paragraphs, etc. And in later paragraphs, they also say that one has to look into the nature. It says preference shares may be issued with various rights. In determining whether preference share is a financial liability or equity instrument, an issuer assesses the particular rights attaching to the share to determine whether it exhibits the fundamental rights attaching to the share to exhibit the fundamental characteristic of financial liability, and ultimately say that preference shares may also be treated on par with equity, in which case in the balance sheet they should be classified as equity. Now, if one goes back to Rule 11UA, one will see that for book value, one has to take a formula which is A minus L by PE into PV, with A being the book value of assets, L being the book value of liabilities, and PE being the paid up value of equity as shown in the balance sheet, and PV being the paid up value of such equity shares. Right? So you have PE being the total amount of paid up equity shares and PV being the paid up value of such equity shares. So now one has to be very, very careful. Ind AS 32 requires a classification as equity in certain cases. So while making the classification, if one were to classify a preference share as equity, then the formula will also apply accordingly, as though it is equity, particularly in the light of this judgment, where the Bangalore Tribunal has said that one has to look at whether it is actually an equity or is preference in substance, not in form. So the classification would also make a difference, in my view, and the observations of the tribunal in this case can go against Assessees, particularly if the classifications are made in such a manner that one could make out a case that it is only a case for equity, which otherwise is issued as preference, though in substance is equity. The next decision is a decision in the context of section 4713, which is on conversion of a partnership firm into a company. Now, this again is a very crucial decision. It may not be applicable only to 4713. It may have to be applicable in very many cases where we may have to think of planning. Now, what happened in this case was very simple. A partnership firm got converted into a company by being succeeded by a company. The assessee claimed that all the conditions in 4713 were satisfied and that therefore there was no liability to capital gains tax in the facts and circumstances of the case. The assessing officer observed that, can I just hold for a minute, please? I'm sorry, I'm breaking for a minute. I'm sorry, I broke for a minute. I'm extremely sorry. Some technical problem here, therefore I had to, request somebody to set it. I hope I'm clear now. Am I audible and clear?
Clear, sir. Clear, sir.
Yes, sir.
I'm
Clear.
really sorry for breaking, but then, as I said, this is the downside of technology also. Right? In fact, as I was saying, this faceless assessment is also now wholly dependent on technology. In fact, I don't know, we have filed response to every single notice that has come so far, but the department says no reply has been filed. Right? No replies have been filed, etc. But be that as it may, I was talking about the decision of the Karnataka High Court in Prakash Electric Company, where a partnership firm was succeeded by a company. A partnership firm was succeeded by a company. Right? Now, according to the assessee, he had complied with all the requirements of section 4713. And according to him, therefore, he was entitled to the exemption by the transaction not being regarded as a transfer. This was the contention of the assessee. On facts, the assessing officer demonstrated that the assessee had allotted only 6,050 shares on the date of conversion of the partnership firm into the company. And it was only 4 years later that he had allotted a balance of 18.5 lakh shares to the partners to be the shareholders, because the section requires that they must be allotted shares in the same proportion in which they are holding equity or capital in the partnership firm. Right? So the Assessees' contention was that they had complied. The assessing officer said, no, you allotted the shares only much later. You should have done it immediately on conversion of the partnership firm into the company. The Assessees' argument before the High Court was that Section 4713 does not place any embargo and does not require allotment to be made immediately on conversion of the firm into the company. Even if the allotment is made much later, Section 4713 will still be complied with, and that therefore, according to him, according to the assessee, the provisions of the exemption that are provided for in 4713 are satisfied. To make myself clearer, I'll put it this way. As of the date of conversion, the condition relating to shares being allotted to the partners in the same proportion in which they held equity capital, capital in the firm was not complied. It was complied only 4 years later. So the contention of assessing officer was that you should have complied immediately. The contention of the assessee was that I can comply at any time. Now the Karnataka High Court came with some kind of a via media, in fact, and said you cannot do it at any time, you have to do it within reasonable time. You cannot do it at any time, you have to do it within reasonable time. Right? You have to do it within reasonable time. And they said reasonable time will mean at least before the end of the previous year. They went on to analyze and say that it is possible that it may take some time to close the financials of the firm, to find out what is the final capital account balances. Some assets may still be remaining which have to be sold, etc. And it may take some more time to draw the financials of the firm. Therefore, some reasonable time can be given, but it should be within the year. Now, where I see that the assessee has planned very badly, he is not looking into the provisions of 47A. 47A says that for a period of 5 years from the date of succession, the shareholding should continue as such in the same proportion. Right? And if there is a change within that 5-year period, then 47A says it will be treated as income of that year in which you violate the condition. Which means that the law is clearly contemplating that the allotment of shares will be made as soon as possible from the conversion of the partnership firm or the succession of the partnership firm by the company. The assessee's claim was we did not have enough authorized capital. The Karnataka High Court said that is your problem, that is not ours, that is not the problem of the revenue. But then on a plain reading of 47A, I would think that the provisions of 47A require that for a period of 5 years, the partners must continue to hold shares in the same proportion. If that be so, that means the law is contemplating that as soon as possible from the date of conversion or the succession by the partnership firm by the company, the allotment of shares should be made in the company in that proportion. It was, to my mind, very poor planning to say that I did not have enough authorized capital, etc. I think this is very, very slipshod and has led the assessee to probably a huge capital gains tax implications, where the assessee thought that he would otherwise be entitled to an exemption under the provisions of the Act. Where the assessee thought that otherwise he would be entitled to an exemption under the provisions of the Act. The next of the decisions is a decision of the Madras High Court again in a case called Anand Kumar versus ACI. In fact, when the organizers requested me to have a discussion on the subject, they were kind enough to send me a couple of examples on what could probably be discussed, and one of them was this itself. In fact, this was a kind of eye-opener. In fact, what I did was I told each one of my juniors in the office, you bring me 1 or 2 cases against assessee where you think better planning or better representation could have been made. And what I did was to just consolidate these decisions, which I am now discussing before you. So to a large extent, I must admit that the credit is due. That the credit is due to all my colleagues in the office. While that said, I must thank the organizers for giving me this example as well. Now, this was a case where the SC was a partner in 3 different firms and received remuneration and interest on capital from all the 3 firms. The SC filed a return of income admitting a total income of about 43.5 lakh and filed the return of income and went for the presumptive rate of tax by offering the income under 44 AD by taking 8% of the 43 and odd lakhs, which was the total amount of income that he had received by way of remuneration. Now, the issue before the High Court was whether 44 AD is applicable in the circumstance. Now, if one were to look at the provisions of 44 AD provides that one can take 8% of the gross receipts as income. And if you see the exact language used, it says 8% of the total turnover or gross receipts of the assessee. 8% of the total turnover or gross receipts of the assessee. Now, the question that arose for debate and discussion and decision by the High Court was whether this amount of remuneration and interest on capital received by the partner from the partnership firms could be taken as turnover or gross receipts. The Madras High Court said that the assessee had not done any sale nor had rendered any services to a third party, but had been just receiving remuneration and interest on capital from the partnership firms, and that had been debited to the P&L account of the partnership firms. And therefore, this cannot be taken as turnover or gross receipts of the business. Now, this Madras High Court went on to analyze that these amounts of remuneration and interest on capital are by virtue of section 28 of the Act to be treated as business income of the assessee. 28(5) treats this as the business income of the assessee, that is the assessee partner. But the Madras High Court distinguished between it being taken as a business receipt exigible under section 28 vis-a-vis it forming part of gross receipts or turnover, total turnover of this, and ultimately concluded that this is neither in the form of turnover nor in the form of gross receipts, because even gross receipts has to be read along with the word turnover. In interpretation, you will have what we call nocit processes, where there are general words that precede specific words. The general words will take their color from the specific words that precede it. So when you say turnover of a business, the gross receipt should be in a manner which is similar to turnover. So gross receipts is associated with a service industry, is what the Madras High Court is probably looking at, and said that this is neither turnover nor gross receipts, and that therefore, according to the Madras High Court, this will not fall within the ambit of 44 AD. Now here, I think it is very, very dangerous. I think assessees have to be very, very careful in the context of not merely 44 AD, but also 44 ADA. In fact, I am personally aware of some of my friends, chartered accountants, who have taken remuneration from partnership firms where they are partners and offered the income under 44 ADA at 50%. Right? So there is a possibility that a similar view will be taken in the context of 44 AD or ADA also. I'm afraid that as things stand today, the decision is against assessee. In fact, if I must go a step further, I must say that I'm inclined to agree with the view taken by the Madras High Court. Because why have they brought in 44AD? See, 44AD is not an amnesty provision. Let us appreciate and understand that 44AD is a provision where it is bringing some kind of simplicity by not requiring a seat to maintain books, etc. in case of small assessees, because they may have some expenses which they have incurred, etc., and they are not able to maintain each and every one, each and everything being now looked into may also not be possible. So they are trying to, in small assessees cases, to look into whether they can have an ad hoc income which can be determined. Now, there will obviously be expenses that are to be incurred. But in case of remuneration or interest on capital, there is largely very little expense that is incurred. Of course, there could be some interest on capital, which is against which expenditure can be there, where because you may have borrowed money and invested in the business. But largely, very few expenditures are involved. What the Madras High Court says is that is not the intent of 44AD, and consequently held against us. So, well, the takeaway is that we don't, try to opt for 44AD or ADA, but instead it would probably do us a lot of good. It would do us a lot of good to try and see if we can actually claim expenditure itself. See, in this very case, it may have been possible that the assessee has some expenditure. For example, my own case, I have depreciation on the car. My car is not owned by the partnership firm, it is owned by me. Depreciation is just breaking for a minute, sorry. Yes. So we may have, we may be better off looking to see if we can claim expenses. As I was saying, in my own case, my motor car is not owned by the partnership firm, it is owned by me. Therefore, against the remuneration that I get from the firm, I claim depreciation and maintenance of the motor car, which I think nobody can dispute. It is very much an allowable expenditure. It is very much an allowable expenditure. That kind of a claim may probably be a better way, and advance taxes paid accordingly would be a better way so that we avoid the payment of interest. The last of the cases that I will discuss, I am not going to discuss the facts of the case in Shriram Ownership Trust, the last of the cases. But suffice it to say that the issue was with regard to an assessee being a private discretionary trust, and the assessing officer saying that it is on par with an individual and that therefore the provisions of 5627 is applicable. The assessee's claim was that 5627 is not applicable. Okay. Assessee's claim was 5627 is not applicable because it is an AOP. The revenue's claim was, since it is a trust which is assessed as a specific trust, it is on par with an individual, and 5627 is applicable. Because in those days, 5627 was applicable only to individual and insurer. Okay. It was applicable only to individuals and insurers. Right. So we have a situation where these were the alternate claims of the assessee and the revenue. The tribunal held that 5627 is not applicable to the assessee. But at the same time, one of the arguments before the tribunal was that the case was a case where the assessing officer had taken up the case for limited scrutiny and later on converted it into a complete scrutiny. He took it up for limited scrutiny and later on converted it into a complete scrutiny, following the prescribed procedures, etc. And therefore, according to him, according to the assessee, what happened was there was a direction under 144A from the Joint Commissioner, which was issued at a time when the matter was in limited scrutiny, not taken for complete scrutiny. But this issue of application of 5627 was not part of the limited scrutiny. I repeat, the issue of 5627 applicability was not part of the limited scrutiny. When the assessment was pending in limited scrutiny, this JCIT issued a direction under 144A to the assessing officer, directing the assessing officer to treat the SC as an individual. Yes. And later on, it got converted into complete scrutiny, and only then the assessing officer itself got a right to examine the implications of 5627. So one of the contentions of the SC was that the compliance was not there of the scrutiny requirements, and therefore the direction under 144A was invalid. This was negatived by the tribunal. So please note, on the legal issue, there was a negative order from the tribunal, but on facts, it was in favor of SC. The revenue took the matter in appeal to the High Court. Before the High Court, the assessee argued that 5627 is not applicable, and also argued that there was non-compliance with the requirements relating to scrutiny, and therefore the 144A direction was bad in law. The High Court held that the 144A direction, whether it is bad in law or not, cannot be examined at this stage, because the assessee is not in appeal before us. If the assessee had come in appeal, then only we can decide that issue. So friends, the takeaway is that if there is a legal issue against you, but on facts in your favor, and if the revenue chooses to go in appeal, at least with a condemnation of delay or belated delay, an appeal should be presented before the High Court, so that the legal issue can also be adjudicated by the High Court. Now, if this were a matter before the tribunal, I would have taken a different view, because Rule 27 of the Income Tax Appellate Tribunal rules may permit you to argue the legal issue, even though that issue has not been taken up in a cross appeal or in a cross objection. But that may be even more tricky in the High Court, given this decision of the Madras High Court in Sriram Ownership Trust. So friends, if there is a legal issue held against you by the lower appellate authority, the tribunal, and if the matter travels to High Court by the revenue, because the merits are in favor of the assessee, then I would strongly urge that we file an appeal before the High Court on the legal issue, so that that can also be adjudicated and we don't get into unnecessary litigation on that point. Now, friends, these were the 10 different issues that I thought I should discuss today for the subject matter which we had taken. Now, I have a couple of questions which have been raised before I break. 5627B also talks about if the investment is from certain classes of companies, this section is not applicable. Other than startups, what are the other class of companies notified here? Notification is in GSR 127E. GSR 127E, notification dated 19th February 2019. Notification dated 19th February 2013, where it says what are the assessees who are entitled to exemption under 5627B. The entire paragraph 4 deals with who are the assessees who are entitled to the exemption. I repeat, notification dated 19th February 2019, notification number 127E. Right? Next, refer to my question earlier. If the department of the capital gain invests equity into a private company being a private freight terminal for a premium, can it be claimed to be outside this section by virtue of the notification? I'm afraid the notification doesn't specifically provide for such an exclusion, but you may examine more in detail. I'm now looking at it prima facie. I'm not having the notification in hand, but prima facie, I don't think there is an exclusion for such companies. You may look at it in depth. I've given the notification number. I'm sorry I'm not able to help you immediately, but if, sir, you can share your mail ID with me, I will certainly revert to you at the earliest possible if you can send me a query on my mail. I am sharing my mail ID so that it will be easier for the participants. I'm sharing my mail ID, which I have done. You can send me the query so that I'll probably look into this and revert. Now, I will pause here for some time, thanking the organizers for the opportunity. Once again, thanking the organizers for the opportunity to share my thoughts on a very peculiar subject, which I am having to, do for the first time in my 25 years of speaking. In my 25 years of speaking, the first time that somebody has approached me with a topic like this. I'm very, very glad I could be part of this. I'm very glad I could be part of this. And I will thank every one of you for a very patient hearing. And also, thanking some of them who have, through the chat, said that the session was quite useful. Thank you all very much. Back to the organizers. I'm in your hands until the organizers call it a day.
Thank you, sir. Thank you very much for spending your valuable time with us. And as you said, the unique topic on direct tax judgment. Now I request Coimbatore Branch Secretary CAD Nagakumar to propose vote of thanks for this session.
Thank you, my chairman and Tribute chairman. Is it audible, sir?
Yes, sir. Yes, sir.
Good evening to all. It's a pleasure. And I, on behalf of the Panchabootha Conference representing 5 branches, Tirupur, Coimbatore, Erode, Salem and Palakkad branches of SCRCF ICA. I thank very much our vibrant and eminent speaker, today's first session speaker of this second day of the 2 days conference, Banusekar sir from Chennai, for delivering such a beautiful and wonderful address to our members. The way he explained and delivered was very, very excellent on direct tax judgment against the assessee in a very, very interesting manner. Various case laws have been explained in detail and in depth by CAT Banusekar sir, covering various important sections. 2M Power Belt Management Services Private Limited and various other case laws have been neatly and clearly explained. So once again, thanks CA Banusekar sir for addressing this webinar and enriching the knowledge of our members. And I also thank all the participants for attending this webinar. Request the members to participate in today's second technical session by Rahul Jindal from New Delhi on the topic discussion on forensic audit along with the practical case studies in financial management. So again, thank from the bottom of my heart for taking such a very beautiful efforts by CAT Banusekar sir for delivering such a beautiful address. And I thank the host branch, the Tirupur branch chairman, C.A.K. Murugesan sir, the secretary, C.A. Saravana Raja sir, and other committee members for giving me this great opportunity. Thank you very much, and Jai Hind, sir.
Thank you, sir. With the permission of the organizers, I leave the meeting, sir.
Thank you, sir. Dear members, we will move on to the last technical session of this Panchabootha Conference on the topic discussion on forensic audit along with practical case studies in financial statement. I request Salem Branch Secretary CAV V. Puspalada to welcome the gathering.
Good evening, sir. Am I audible, sir?
Yeah, yes, madam.
Yeah. Good evening to one and all virtually gathered here. I feel immense pleasure in welcoming you all to this technical session of 8th Panchabootha Conference. I'm honored to remember C.A. Gunasekaran sir, the initiator of this Panchabootha Conference. Here, the forensic audit is an important need in this requirement in the current scenario. In this respect, we have a great speaker, C.A. Rahul Jindal from New Delhi, to discuss about the forensic audit along with the practical case studies in financial statements. I assure that like all other technical sessions, all the participants will enrich their knowledge with this technical session. I request our past chairman of Salem branch, CA AV Arun sir, to introduce the speaker to the forum. Thank you, and all. Thank you.
Warm good evening to one and all present here. Today, the session, a discussion on forensic audit along with practical case studies is handled by Rahul Jindal. As of now, we as auditor handling only the indirect taxes and direct taxes, but in the current scenario, there is the forensic audit is gaining momentum due to lot of business failures due to frauds, financial frauds in India. So it gaining momentum. So now the big firms having the separate division for forensic audit in their firm. So I think Mr. Rahul Jindal is heading the PVR & Co. forensic division of the firm. He is a fellow chartered accountant, LLP and DISA certified fraud examiner and certified forensic auditor, IBBA registered valuer, certified concurrent auditor and diploma in IFRS. He's handled more than 35,000 crores of forensic audit for public sector bank, private sector banks, BSc and other financial institutions. He has taken seminars for various institutions such as NIRC ICI, SIRC ICI, WIRC Study Circle, Bank of India, Economic Offense Wing, NIRC Study Circle. I think after his session, we may be having the good knowledge in forensic audit. We may get some introduction and lights on the forensic audit. As the tier 2, the tier 3 city chartered accountants, we thought that the forensic audit and all, it is belongs to big cities like Bombay, Chennai and other part. But now, so each and every financial institution concentrating on their business failures in forensic audit. So with this small introduction, I welcome Mr. CA Rahul Jindal in this forum. So thank you, one and all.
Thank you, Arun sir. Now I request the speaker to address our member.
Thank you, everyone. First of all, I'd like to thank Tirupur branch, along with the other branches that are there, for conducting such a technical sessions for 2 days. So I'm really happy to be giving the closing remarks or the closing session for this 2-day session. So now regarding the forensic audit, I'll tell you this is a very, very upcoming and an important topic that is being undertaken by various firms all over India. So as you must be knowing that I'll give you a brief about forensic audit. What is the scope, what is the purpose, and then we'll have a discussion on the practical case studies. So first and foremost, the discussion comes is regarding how to get the forensic audit and what is its importance. Forensic audit is done when an account is classified as a non-performing asset by the banks or any other agencies who have given the loan to the borrower. So in case a borrower is classified as a non-performing asset, in that case, as per the RBI guidelines, now they need to undertake a forensic audit. Even though the guidelines are for above 50 crores, that if the outstanding balance is more than 50 crores, then forensic audit is required. But now the banks are doing audits for various accounts which are even below 50 crores. So now there is no restriction for 50 or below 50. All the accounts which are being classified as an NPA need to undergo through this process. Now the question comes how to get the work. For getting forensic audits, you need to get your firm registered with Indian Bank Association, IBA. So as you must be knowing, there was a form for empanelment by the IBA in last week. So they had opened that form around 20th July and that was valid till 2nd of August. Now they have empaneled a lot of firms all over India. They have empaneled around 400 firms all over India for undertaking forensic audit. Earlier in 2016, there were only 39 firms which were empaneled to undertake forensic audit. I was one of them. Now the number of firms that they have empaneled has increased to 400, around 400 to 500 firms have empaneled. So if any one of you is interested in undertaking forensic audit or taking assignments from banks or any agencies, you should get your firm first empaneled with IBA, Indian Bank Association, after which you will be eligible to take forensic audits. So now the panel for this year has been made. Now you have to apply it next year. Generally, the panel is open in June, July, and August, depending on this COVID situation. So it was delayed this year. Early, it used to be in March, but due to COVID, they have opened the form in July and August. So now it will open next year. So anyone of you who is interested in undertaking forensic audit, they should definitely apply for that, because it is a very upcoming assignment. It is a very upcoming field, and it is a very remunerative field as well. Now, this is a brief. Now I'll tell you why forensic audit and what is to be seen in forensic audit. What is forensic audit? Before understanding what is forensic audit, we need to understand what is fraud. Because our main purpose of undertaking a forensic audit is to identify whether any fraudulent transactions have been undertaken by the borrower or not. This is our main scope. Our main purpose is regarding identification of account as a fraud or a no fraud account. Now the question comes, what is fraud? There are various definitions. I'll share the PPT with the branch. They will share it with all the members. So you need not note down anything. You just have to listen to me. We'll discuss each and every practical aspect. We'll discuss the scope of forensic audit, how it is undertaken. Even though it is a short span of time of 1.5 hours, but still we'll try to cover maximum points as possible. So before understanding forensic audit, we need to understand what is fraud. Even though fraud has been defined under the various acts, you will say Companies Act, it is defined under IBC, it has been defined under various acts. But if you will ask me a simple definition, this is the simple definition. Anything which is done with an intent to deceive anyone is defined as fraud. You can use this definition anywhere. Anything which is done with an intent to deceive. The intent is the key. Intention is the key. Let me tell you, if you are doing a forensic audit and you classify the account as a fraud, and later on it comes to know that it was not an intentional mistake, rather it was an unintentional mistake, then in that case, no government agencies will take action against the borrower in case of an unintentional loss. Now the question comes, how will you identify whether it is an intentional loss or an unintentional loss? Reason being, you cannot go into the mind of the borrower to understand whether he has done this thing intentionally or whether the loss is an intentional loss or an unintentional loss. So for that purpose, the banks, the appointing authorities gives us a scope of work. The scope of work may be 10 points, 12 points, 15 points, whatever the case may be. They give us a scope of work on the basis of which we have to provide our observations and we have to comment on that. When I'll go through the scope of work, you will easily able to identify whether the act was done as was an intentional act or an unintentional act. You will easily come to know. So main and the first and foremost thing is proving the intent. If I'll show you the definition as per the Companies Act, I have highlighted the important parts. Any person, any act done by any person with an intent to deceive against the interest of the company. So any act done by any person with an intent to deceive against the interest of the company is called fraud. So basically you have to understand any act which is done with an intent to deceive is fraud. I'm focusing on the word intention. Let me give you an example for an easy understanding how to prove the intention. All of you are in south base, so usme wahan pe there must be solar power plants. Solar energy is a lot there. So let me tell you, there were various companies which had set up solar power plants in 2006, 7 and 8. Reason being, the government was focusing on renewable energy. So since the government was focusing on renewable energy, many of the companies were focusing towards setting up a solar power plant. And as you must be knowing, during 2006, 7 and 8, the rate per unit rate of electricity was around 19 rupees, 18 rupees, 19 rupees per unit. So on the basis of that, if I wanted to set up a solar power plant, so per megawatt, the cost is around, let us assume it is 5 crore rupees. Per megawatt, the cost we assume as 5 crore rupees. So if we want to set up a power plant of 200 megawatts, we'll be needing a funding of 1,000 crores. So on the basis of that, and assuming that we will be earning 18 rupees per unit, we used to make our projections. The fixed cost and the variable cost would come out to be 10 or 11 rupees. So there was a profit margin of around 7 rupees. So we'll take a profit margin of 33% for solar companies when the per unit electricity rate was 18 rupees. So what happened? I went to the bank. I said, I want to set up a power plant of 1,000 crore rupees. Please fund me 750 crores. 250 will be my promoter contribution. So generally the bank sanction the loan in form of 70 to 75% is the bank loan and 20 to 25% is your promoter contribution. So I approached the bank to give me a loan of 750 crores and 250 crores will be my promoter contribution. That is on the basis of assumption that I will be earning 18 rupees per unit of electricity. What happened? During the period of 2012, 13, 14, the government went into the procedure of reverse bidding. The government said, you tell me what is the cheapest rate at which you can provide me the electricity. And it was open all over the world. So many Chinese companies, Japanese companies, they came, they said, sir, we'll provide you electricity at 15 rupees. We'll provide you at 12 rupees, 10 rupees, 8 rupees, 6 rupees, 5 rupees, 4 rupees. In today's date, the rate is around 1 to 1.5 rupees per unit. Now you assume me as a borrower who had set up a plant of 1,000 crores projecting an income of 18 rupees. But what I'm getting today, I'm getting 1.5 rupees. My fixed cost, variable cost is 12 rupees. In that case, I cannot survive in any case, and I will not be able to repay my loan in any case whatsoever. This is a case of a genuine business loss. This is a case of an unintentional business loss. I'll give you an example of an intentional business loss now. I hope this unintentional thing is clear to you. I'll give you an example of an unintentional business loss. I was doing forensic audit for a company which was dealing in rice. The first and foremost thing that you need to understanding is you have to put yourself into the shoes of the borrower, and then you have to see whether you would have taken the same steps that borrower has undertaken. What would you have done had you been in the shoes of the borrower? Now, I was giving you an example of a rice industry. So what happened? I was doing a forensic audit for a rice industry. It had a limit of around 600 crores. अरे माइक म्यूट कर लीजिए सर. हाँ जी, अरे माइक म्यूट करवाना पड़ेगा सर. हाँ जी. So I'll give you an example of an intentional business loss. So we were doing forensic audit for a company which was dealing in rice. It had a limit of around 500 crores. So when we undertook that audit, we observed that the company was holding a stock of around 100 crores and they were holding a debtors, trade receivables of around 600 crores. When we asked the company to why they are not able to recover 600 crores, the reply of the company was that, sir, we are trying to recover that money. We have sent them demand notices, but they are not paying. What we can do? If I was in their place, what would have happened? I would have tried to recover the 600 crore and pay back the banks. I would have sent them legal notices. I would have taken them to the court. I would have filed an application under insolvency. I would have rigorously followed up with the debtors to recover that money and pay the banks. But the reply that I got from the borrower was, sir, we are trying to recover. We have sent them demand notices for last 2-3 years. We are trying, but we are not able to recover. This clearly proves that his intention is malafide. It clearly proves that his debtors were overstated. He was booking fake sales just to arrive at drawing power. I hope you must be knowing regarding rice, steel, jewelry. As soon as an account is classified as an NPA, either their stock becomes bad or the debtors become bad. Reason being, the main drawing power that is allotted to them is against stock and debtors. That are the main scenarios that are there. So you need to understand all those examples. I'll give you one more example because I have only practical case studies. I have undertaken more than 100 forensic audits. So I have only practical case studies to share. I hope you will be able to link it with that. I'll give you one more example. I did a forensic audit for a company which was dealing in agriculture products. So what happened when we were doing forensic audit, we observed, we verified the transportation documents. When we verified the transportation documents, we observed that a particular truck number, a particular vehicle number was making 130 trips in a day of 50 kilometers. A particular truck number was making 130 trips to and fro of a distance of 50 kilometers in a day. It is not possible in any way that a truck can make such amount of trips in a single day. This clearly proves that he was making fake documents, he was inflating his sales purchases, he was inflating his debtors and stock before the banks. This is a case of an intentional mistake or intentional loss. This is a case of an intent to deceive the banks so as to claim the drawing power, so as to claim bank facilities from the banks. So you have to, while undertaking forensic audit, the most important thing is you have to keep yourself into the shoes of the borrowers, and then you have to imagine what would you have done had you been in the place of the borrower. If you find that, like I gave you an example of solar power plant, these things are not in your hand because the loss is due to the change in government policies. So had I been in the shoes of the borrower, I would have not been able to do anything. But in case I am showing debtors, I am showing stock, which is not available, which is not recoverable, and I have not taken legal steps or effective steps to recover that money. This clearly shows my malafide intention. In that case, you can clearly write on the report, okay, on the basis of records and documents produced before us, we are of the view that the debtors might be inflated by the borrower just to claim higher drawing power, hence falling under the definition of fraudulent transactions as per the RBI Master Circular. I'll give you the reference of RBI Master Circular where they have clearly defined what is fraud, what is diversion, what is siphoning of funds. You can give reference of that in your reports. Let me tell you, report writing is a separate task altogether. There are three things involved. First, you have to get the work. Secondly, you have to undertake the work. Third, you have to present the work. All these three are a separate task altogether. So if you are interested in doing forensic audit, you should be ready to follow up with the banks to get work. Then you have to undertake the work in a time-bound assignment. And the last thing is you have to present your report before the Committee of Creditors or JLM, Joint Lenders Forum, or the bankers, I would say. So undertaking forensic audit is a very, very good area for the newly or the firms. It is a cream area, but for that you will have to work really hard. You will have to get your firm impaneled. You will have to follow with the banks for getting work, and then you will have to present your report before the government agencies as well. Because as soon as you classify the account as a fraud, your report will go to all the government agencies, whether it be CBI, UOW, or SFI or ED. And all these four government agencies can call you anytime to discuss that report, and you have to maintain your evidences properly. Like I am being called by CBI, UOW, or ED regularly for discussion of forensic audit reports that I send to them. So for forensic audit reports, you have to ensure that you maintain a proper working records, and the working records are to be maintained for a period of 8 years. That is similar to the Companies Act. So you have to ensure that you maintain the proper working records and evidences on the basis of which you have prepared your report. Because reason being, the government agencies guy can ask you each and every document that he might be needing. I'll give you an example that what document I was asked. I had submitted a report of 400 pages to CBI. The CBI guy did not ask me anything. He just asked me, sir, you have sent confirmation letters. Please bring the courier slips to me. He did not ask any evidences of the reason for fraud or anything. He just asked me to show the confirmation letter slips, courier slips, to prove that I had actually sent confirmation letters to the debtors. So they can ask you anything. They can ask you each and every, whatever you've written in the report, you should have appropriate documents for that while undertaking any forensic audit. Now coming back to our main scope, while undertaking forensic audit, why do people commit fraud? If you have done FAFD for FAFD course from ICI, you must have studied this. So forensic audit, or the why people commit fraud, there can be three scenarios. There is an opportunity, there is a rationalization, there is a motivation. What is opportunity? Satyam, Kingfisher, Nirav Modi, all these are opportunity. Reason being, the top management had the opportunity to undertake such fraud. Motivation, PNB scam. He had the motivation to earn more than the actual salary that he was earning. That is motivation. Rationalization. When you are working and you think that you should earn more rather than what the company is paying to you. So you are trying to rationalize things. If suppose two employees are working in a company, one employee is getting 1 lakh rupees and another employee is getting 50,000. Both of you are doing same work. So in your mind, you will try to rationalize, since we both are doing same work and he's earning 1 lakh and I am getting 50,000. In that case, the company owes me 50,000 more, whether it be a legal source or an illegal source. So he's trying to rationalize, he's trying to justify why will he commit fraud. So whenever any fraud is undertaken, any of these three things will always be there. There will be opportunity, there will be rationalization, or there will be motivation, anything. Like PMC Bank, the Bombay one, it was an opportunity, since the top MD or the directors, they had the liberty to sanction ad hoc limits, to sanction limits to companies which were not eligible to get the loans. So whenever any fraud is undertaken, it will fall under any of these three categories. Now question comes, what is the difference between a statutory audit and a forensic audit? If you will ask me, as per the CARO 2020, if you have studied CARO 2020, there is not much difference left between forensic audit and a statutory audit. But we are discussing the scenario prior to CARO 2020. What was the scenario? So normal statutory audit transpires prior to issue of financial statement. So any statutory audit is done prior to issue of financial statement, whereas forensic audit is done after the financial statements are issued. Forensic audit is always done for prior period. Suppose we are sitting in 21. So forensic audit will be done for a period of 3 years, 4 years, 5 years prior to today's date, depending on the scope and time period given to you by the appointing authority. While doing statutory audit, we don't have any assumption that fraud might have taken place. We are assuming that the company is working very good and everything is fine. Whereas in case of forensic audit, we are of the view that some fraud might have taken place. Some fraud must have taken place. Like you must have studied a phrase, the auditor is a watchdog, not a bloodhound. In this case, in statutory audit, you are a watchdog, but in case of forensic audit, you are a bloodhound. The purpose of statutory audit is to assist in reaching a financial decision, whereas the purpose of forensic audit is to reach a legal decision. As I told you, your reports will be going to various government agencies, CBI, ED, UW, SFIU, they'll be going to various agencies. So on the basis of your forensic audit report, the legal decision will be taken by the bank. In case an FIR is to be filed, it will be on the basis of your report. So you have to be very careful as to what you are writing on your report and what you are not. You have to be very, very sure. I'll tell you, if you are doing forensic audit for the first time, then you should get your report read by someone who has done at least 20 to 25 forensic audits. Because in that case, he must be knowing that what is to be written and how it is to be written. The writing of language is very, very important in forensic audit report. I'll give you a perfect example for that. I was doing forensic audit for a software company. No, not for software company, for a jewelry company. So what happened? We were seeing the good receipt note. We were verifying the good receipt note, GRN. So when we were verifying the GRN, we observed that the handwriting of the sender and receiver of the goods were same. The handwriting being on the basis of our view. We observed that the handwriting of sender and receiver were same. So what happened? I had written in my report, I'll tell you the exact words I had written in my report. It seems that the handwriting of sender and receiver are same. However, since we are not a writing expert, we are unable to confirm the same, and the same requires further investigation. We wrote these 2 lines in our report. When the banks filed the complaint before CBI, the language that the banks have written is this. As per the forensic auditor, the handwriting of sender and receiver are same. Hence, the sales and purchase are inflated, and this is a fraud account. This is what the banks had written. So what happened? I was called by the CBI guy in Delhi. He called me. So he first and foremost asked me, "Sir, are you a writing expert?" I said, "No." Then he was saying, "Sir, how can you certify or how can you write that the writing is same or different?" So I told him, "Sir, I have not written anything like that in my report." He showed me the complaint filed by the bank that said this is what the bank have written to us. I asked him, sir, do you have my report? Yes, he told me yes. He showed my report. I opened the specific page. I told him to read what I have written and what banks have written. He was amazed to see I have written the language I told you and what banks have written. He called the bank guy and banished him like anything. That how on what basis you have written these things. So writing of forensic audit is very important. What you are writing, how you are writing, and what is the language you are using is a very, very important thing while doing a forensic audit. So now our main focus comes on scope of forensic audit. So I request everyone to listen it very carefully. This is the scope that I will discuss with you. This is a point-by-point scope, and I'll discuss the practical examples. The maximum I can discuss as per the time constraint that we have. So this is the scope that there is a forensic audit. In case we have some time at the end, I'll discuss the scope of transaction audit as well with you. But first and foremost, we'll be going to the forensic audit. When I will discuss the scope of forensic audit, you will see that the complete balance sheet and profit and loss are covered in the scope. The complete balance sheet items, assets and liabilities, and the profit and loss items are covered in that. So first point is tracing the source and genuineness of contribution by promoters in form of equity debt infused by promoters. So the first and foremost point that we have to verify is the contribution. Mute करना पड़ेगा सर. Mathivan and R सर म्यूट कर लीजिए सर अपने आप को. So the tracing the source and genuineness of contribution by promoters. In this case, we have to verify whether the promoter contribution is genuine or not. The main thing to remember in this case is we don't have to just check the bank entries. As you must be knowing, many of your clients must be coming to you to get a promoter contribution certificate. Many of your clients must be coming. Please do not sign that certificate unless and until you have verified the source of contribution. Now, what do you mean by source of contribution? Suppose there is a company A. It has two directors, B and C. B introduced funds in company A. No, the funds have come into company A. Now you don't have to check the bank statement of A, but you have to check the bank statement of B and C. What is the source of their contribution into the company A? Suppose for an example, B received funds from his son. In that case, you have to ask the bank statement of his son. Suppose his son received money from his wife. You have to ask the bank statement of his wife. Now the question comes to what level you have to go. Sir, you have to verify the genuineness of contribution till you find an unrelated party. Till you are getting a related party, in that case, you have to specify, you have to check the contribution and source of such contribution. Checking the bank entry in the bank statement of the company A does not suffice your purpose. And please do not sign any such certificate unless and until you are able to verify the contribution by promoters. I'll give you an example that happened recently with me, and I'll tell you the repercussions of that. There was a company in Uttar Pradesh, I was doing UP. I was doing their forensic audit. I observed that the company paid funds to the creditors paid money to the promoters, and promoters further infused funds into the company. So company paid to the creditors paid to the promoter, and promoter further infused funds into the company. So this was not a genuine promoter contribution. This was just round tripping of funds. This was just circular trading, whereby funds were being routed to creditors, promoters, and back into the company. And there was no genuine promoter contribution. I wrote that in my report and I classified the count as fraud. Now I will tell you the repercussion that the statutory auditor has to bear on this. The statutory auditor of that company had given a certificate regarding promoter contribution that the funds have been infused into the company. That the funds have been infused into the company. Now I'll tell you what the bank did. Bank in the newspaper of that state, they published a full the statement that they publish, that this company has undertaken fraud and the statutory auditor is involved in this fraud. They have written that in the newspaper of that state, let me tell you. Even though the statutory auditor has given a certificate, I read that language, he has given that the promoters have infused funds in this form. He has not commented on the genuineness or source of contribution. But if you are signing any such certificate regarding promoter contribution, you have to be sure that you verify the source and genuineness of contribution. I'll give you an example of NHAI, the companies into infrastructure and road projects. What they do, they have a holding company and they form many SPVs. It is called special purpose vehicles. What they do, they get funds from banks, they get funds from NHAI as a grant. Once they get funds, suppose there is a company, suppose I'll say there is a company A. It has companies in 20 states as an SPV because there is a condition of NHAI that if you want to take a road project, then you should have a company in that state. It is mandatory. In that case, what was happening? The company, what was happening? The companies were receiving funds in form of mobilization advance rather than in form of capital contribution. And these funds were paid back to the holding company. Company A ko paisa mila, company A received the funds. They paid back the money to the companies in form of mobilization advance. So there was no promoter contribution in that case. There are various examples that you can come through for regarding promoter contribution. I can share n number of examples. But in first point, you have to verify the source and genuineness of contribution. You don't have to rely on the bank statement of company A. You have to verify the bank statement of B. You have to verify the bank statement of C. So you have to verify their statements. You have to check on from where did they infuse the funds, whether it was an FD, it was an old outstanding balance, or they have received funds from someone to whom company has paid. I gave you an example that the company paid to creditors, creditors paid to promoters, and promoters further infused the funds into the company. That is not promoter contribution. That is just round tripping of funds, and that is fraud because he has undertaken such transaction with an intent to deceive the bankers. Second point, verifying revenue from operations, including sales, purchase, everything. Now the question comes, you have to verify the revenue. First and foremost, you have to bifurcate. In verification of revenue, you have to bifurcate whether it is a manufacturing company or a trading company. I'll tell you. If you are doing an audit of a manufacturing company, what I do, I first and foremost ask them to produce a gate pass register. I'll tell you why. I'm talking about the manufacturing industry. See, if anyone in today's scenario, if anyone wants to undertake a fraud, they can easily prepare the invoices, they can easily prepare the transportation documents, they can easily prepare the way slip, they can easily prepare the good receipt note, purchase order, sale order, everything can be prepared. It is very easily preparable. But there is one item, that is gate pass register. That is the most difficult item to make. Reason being, I'll tell you the reason for that. Because in that register, you have to maintain a lot of information. At what time the truck came, who was the driver, what is the truck number, what was the truck carrying, at what time it entered into the factory, at what time it left, with what goods it left, who was the driver, mobile number. So there is around 10 to 12 informations that is to be feeded in the gate pass register. So it is not a very simple job to make a gate pass register. If the company has a gate pass register, there is a possibility that the company is actually undertaking manufacturing activities. But if you are doing a forensic audit for any manufacturing industry and it does not have a gate pass register, 99% chance is there it is not undertaking any manufacturing activity. It is just either undertaking trading activity or it is either inflating its sales and purchase. So you should ask for the gate pass register for doing a manufacturing industry. Now we'll come to the trading industry. If you are doing forensic audit of a trading industry, you should calculate the cost of goods sold. This is called COGS ratio. I'll tell you the reason for that. Since if you are doing any audit for any trading industry, If the COGS ratio or the gross profit ratio, the cost of goods sold ratio is very, very low, it means that the borrower is selling goods at a negligible margin. And if he's selling goods at a negligible margin, then then you should not undertake that business, since the interest rate is around 10 to 12%. But he's booking a profit of just 1%. What I mean by negligible profit. Suppose you are purchasing an item for 100 and you are selling it for 101, 102 rupees. You are booking a profit of just 1 rupee, 2 rupee. But you are paying an interest to bank of 12%, 13%. There is a high possibility that he's just inflating his sales and nothing else. So whenever your company, I'm telling you these things, these can be useful for you while you are doing a normal statutory audit as well. So in case of manufacturing industry, if I do statutory audit, I simply ask the manufacturer to produce the gate pass register to verify and to check that. If there is someone in trading industry, I just calculate the profit and question the borrower, why are you undertaking trading sales at such a negligible profit? It's better you shut down the business rather than doing sales at a negligible profit and booking losses. I'll give you another example. Hotel industry. Now, what the hotel industry does, they have two softwares. In one software, they maintain their books of accounts, and they have a software which is being maintained at the reception of the hotel, which is for the details of the guests that come to that hotel. So what I do, if I do a forensic audit of a hotel industry, I'll simply ask him to give me the details of the guests that have come into the hotel. That is from their software on the reception. I did an audit for a hotel industry, and what I observed was, suppose there were guests, around 2,000 guests were there in a month. When I asked him to provide the complete details, like name, the residential address, the email ID, the mobile number, the Aadhaar card, the PAN card, because all these details are taken by the hotels now. So I observed that out of 2,000, 400 customers had same number, mobile number. The PAN number was not filled in them. 400 customers had same mobile number that was fed in that system. I questioned the management that why same number has been fed in. They told me, sir, the customers were not ready to share their mobile number, hence our staff had fed their own mobile number. I accepted their explanation, but these 400 did not have their PAN number or Aadhaar card fed in their system as well. This clearly shows that he was overstating his sales in his books of accounts just to inflate his sales. He was booking fake clients, that the fake clients were coming to his hotel, that the 2,000 customers were coming to his hotel per month. There is another, I'll tell you a simple example, what I do while doing a forensic audit of an hotel industry. Suppose for an example, 2,000 customers per month are there, so you divide it by 30. So generally you will say there are 60 customers that are per day, and on an average, there are 60 guests on an average in a day in a hotel. What you should do? Generally, while doing a hotel booking, the breakfast is included in that hotel, in that booking that you are doing. Generally, I'll say the breakfast is included. So what you should do, you should visit the area where breakfast is being arranged from 9 to 11 or whatever the timing is. And you see how many customers are coming for breakfast. Since it is free of cost, maximum of the guests will come for breakfast in the hotel. Let me tell you. I'm telling you the practical scenarios that I'm not only discussing the financial aspect, I'm discussing the other aspects as well. So if you're doing an audit for a hotel industry, you should visit the hotel at breakfast time. I did it myself, let me tell you. I did it for a hotel in Gurgaon, and I did it myself. I visited the hotel on breakfast. For an example, there were 60 guests. When we visited, we observed there were not more than 5 guests on that day. We assumed it is fine. We visited next day. There were 6 guests. This clearly shows he does not have that average guest that he's showing. He has very less number of guests as compared to the guests that he's showing in his books of accounts. Reason being, generally the payments for guests, the hotel is either done in cash or through card. There are no bank transaction, transfer, nothing like that. So while doing hotel industry, you will have to rely on the financial data, but you will have to apply your mind and visit the hotel and see how many customers are there. You have to sit in the lobby. You have to see the walkovers of the customers. You have to visit the breakfast area where breakfast is being undertaken. So there can be various scenarios by which you can verify the sales. Like I told you, the manufacturing industry, you have to verify the gate pass register. Similarly, for trading industry, you have to verify the profit margin. For hotel industry, I've told you. Similarly, is the case for rice industry. I'll tell you for rice industry, how can you verify that thing? Generally, in rice industry, what happens? The borrower purchases paddy. They purchase paddy and they convert it into rice. And the limits that are being sanctioned to this rice industry is manufacturing limit against the stock of rice and not paddy. So what was happening when I did the audit? I observed that many of these companies what they were doing, they were purchasing paddy and selling paddy. They were not manufacturing rice at all. And they were claiming drawing power against such thing from the banks. Even though as per the sanction letter, they were allowed drawing power only against the stock of rice. So if you're doing rice industry, what you have to do, first and foremost, you have to check whether in actual he's converting that paddy into rice or not. That will come from the stock register, the sale register will come. Secondly, you have to check the consumption rate. What is the consumption rate? Suppose the consumption rate is 60%. Suppose for an example, on the basis of consumption of 100 rupees of paddy, you can get 60 rupees of rice. You have to compare the consumption rate year-on-year basis or month-on-month basis. The reason being, rice has a specific season cycle. Suppose the season cycle of rice is from, I'll say suppose from October to March is the season cycle. So you have to see during what season the sales are being booked. I'll tell you in one of the scenarios in rice industry, I've done rice industry for more than 10 accounts I've done. I observed that the company was booking sales of rice in season in which it was not possible to produce rice. So now coming back to the financial aspect, you should know the technical aspect as well. You should know the background of an industry. Before starting any forensic audit, you have to have an background industry understanding of the industry that you're auditing. Like I give you an example of a solar industry, rice industry, jewelry, steel, agriculture, software company. So there are various companies for which you will be doing forensic audit. I have done almost for every industry. I've done for solar industry. I've done it for software industry. I've done it for infrastructure company. I've done it for EPC contractor. I've done it for jewelers, rice, steel. So once you do forensic audit for all these companies, you will get a very good understanding of these industries. I'll tell you why rice industry I'm talking about. Till 2012, 2013, all the rice industries were in profit. They were in actual profit. But what was happening? They were overbooking the rice. What do you mean by overbooking? Suppose I'm sitting today. I asked my broker to sell me rice at suppose the rate of rice is 30 rupees per kg. I asked him to book, say, 10,000 tons of rice for me at rate of 30 rupees. Even though no stock has come or gone from my company or no sale purchase is undertaken, I have just asked him to book a rice at 30 rupees, 10,000 tons I have asked him to book for me. Suppose I'll say 10 tons. What happened? During the period of 14 and 15, there was downfall in the rate of rice. From 30 rupees, the rate went to 25 rupees. It went to 20 rupees, 15 rupees. Due to such downfall, they were not able to recover from that. And since they were not able to recover from that, they were not able to book actual losses in their books of accounts. The reason being, the value of stock deteriorated 50%. So to compensate that, what they did, they were overstating their stock, they were overstating their sales and purchases, overstating their sales. Hence, if you are doing a audit for a rice industry, you should know what is the current rate at which the rice is selling. And it is not very easy to find that out. Reason being, rice has various qualities. There can be broken rice, there can be complete rice, white rice, brown rice. There are various quality of rice that are there. So while you are undertaking any forensic audit, you have to understand that industry, that what is the rate at which they are booking the sales and stock they are booking. I'll give you that example. I'll give you one more example of stock. how the company manipulate their financial statements. As per the notes to accounts of the company, it was mentioned that the stock is to be valued at on FIFO basis, first in, first out basis, as per the notes on accounts. But when the company was submitting stock statement to the banks, it was valuing its stock at weighted average. And because of which they were overvaluing their stock in the stock statement by around 50%. So had the actual stock was 100 crores, but they were showing 150 crores as stock in their stock statement. And what was their fault? In books of accounts, they were valuing the stock at FIFO basis, but in their stock statement, they were valuing the stock at weighted average basis. So this is a type of fraud that they were undertaking. They were even though the quantity was same, but the rate at which they were multiplying the quantity was separate. So you have to verify the sales. You don't have to restrict yourself. I'm telling you, even for statutory audit. Reason being, I'll tell you why the reason it is very important. Caro 2020 has made a lot of amendments. I guess you must have undertaken, you've seen the seminars for Caro 2020. Now they are asking to specifically certify that the stock statement tallies with the books of accounts. You have to clearly state that. You have to verify whether the funds have been utilized for the purpose for which they were sanctioned, the bank loans. You have to certify whether the company will be able to meet its liabilities in future or not. There are a number of amendments in which there are around 50 sub-clauses now you have to report in Caro 2020. So all these points that I'm discussing with you, you can strictly and compulsory apply while doing statutory audit as well. If you are doing a stat audit of a company which is into manufacturing industry, ask him from the Gate Pass register. You will easily be able to identify. If your company is into trading industry, ask him to calculate the COGS ratio and calculate whether he's selling the goods at profit or loss. If your company is into hotel industry, ask him to produce the record of the reception, the guest register from the reception. So all these scenarios can be used by you while doing a normal statutory audit as well. The third point comes is regarding receivables. Now this is the most important point regarding receivables. Why it is important, I'll tell you. Generally the funds, the limits given by banks are either in form of a fund-based limit or a non-fund-based limit. In case of fund-based limit, the fund-based limit is further divided into term loan or CC limit. In case of CC limit or an OD limit, the primary security that the banks have is the debtors and the stock. This is the primary security. In that case, it becomes very important for you to report on trade receivables and the stock summary that is there. In order to identify the trade receivables, there are various scenarios that can happen. I'll discuss various scenarios for trade receivables, because generally in case of CC limit, at the end, all the trade receivables become non-recoverable. So if you're doing any audit, if you're doing any statutory audit as well, let me tell you why it is important. Now, as per Schedule 3, the amended Schedule 3, you have to bifurcate your trade receivables. Aging analysis of trade receivables is to be done in 5 parts. What are those 5 parts? Up to 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, and more than 3 years. So trade receivables is to be bifurcated. Aging analysis to be done in 5 parts. Further, you have to bifurcate trade receivables, undisputed considered good, disputed considered good, undisputed considered doubtful, and disputed considered doubtful. You have to bifurcate your trade receivables in these 4 parts as well. So you have to bifurcate your trade receivables into these 20 columns now as per Schedule 3. Hence, while doing forensic audit, verification of trade receivables becomes very important. Now, how will you verify? So in point number 2, you have verified the sales. So you did not come across any discrepancies. For an example, you found each and every document of trade sales purchase to be okay. Next thing that is to be verified is receivables and payables. How will you verify the receivables? First and foremost, you will send them confirmation letters. You have to send them confirmation letters as per the addresses available in public domain. So for the companies, you can use the addresses as per the MCA. And for proprietorship firms and for other than partnership firms, you can rely on the bills, supporting documents made available to you, and the addresses specified on that. So first and foremost, you have to send them confirmation letters. Secondly, what you have to do, you have to, if possible, you have to physically verify them. Now, what do you mean by physical verification? In that case, if it is possible, you have to physically visit the debtors and request them for confirmation. I am again saying request, since you don't have the authorities and power of a government agent. You can request them to provide the confirmation. In case they are not able to provide the confirmation, you just have to write in your report, you have to click the photographs of the area that you have visited, and you have to attach that in your report, and you have to write in your report that we have visited such area. However, the confirmation was not made available to us. I'll tell you an example for this. We were doing forensic audit for a company in Calcutta. That company, the borrower company, had forwarded 3,000 crore rupees to 788 companies. 788 companies, 3,000 crores had been given to them as an advance. What happened? All the 788 companies had an address of Calcutta. So I asked my staff to get the addresses of all the 788 companies. When we compared those 788 companies, we observed out of 788, 398 had same address. Around 400 had same address, I'll say. So half of the companies had same address. It was in Salt Lake in Calcutta. I asked my staff specifically to visit that address. When we visited that address, it was a 10 by 10 shop with shutter on it. It had a shutter on it. It was a 10 by 10 shop, very small shop. This clearly shows he had diverted these 3,000 crore rupees in form of advances to these companies by showing fake addresses. We were able to identify this since by doing physical verification. Similar is the case for debtors. If you see that suppose the company has a receivables of around 100 crore from a company, when you go for physical verification, you observe that it is a small shop of 10 by 10 and there is no board, nothing else, and 100 crore rupees is to be received from that company. This clearly shows it was just a round tripping, just inflated sales, nothing else, and these are fake debtors. This clearly proves the intention of the borrower, that he was inflating his sales just to inflate his debtors and claim higher drawing power. So in case you are not able to find anything in sales, the next step is debtors. I am 99% sure if the debtors are outstanding in the company, then there is a 100% chance that it is a fraud account. Let me tell you. Unless and until it is an EPC contractor company or an infrastructure company. Reason, I'll tell you the reason for that. In case of infrastructure companies, what happens? Their receivables become outstanding for 2 years, 3 years due to the delay in government, allotment by government. So suppose for an example, you are developing a road. I'll give you a practical example. I was doing an audit for an NHI company. So the borrower was developing a road for NHI. So what happened? He developed 70% of the road was developed by him. So around 270 crores were recoverable from NHI. But NHI did not pay him a single penny. Because as you know, because as per the contract of NHI, unless and until 100% work is done or there's a completion certificate from an engineer, they will not pay you even a single penny. So 70% of work was complete. They received some payment although, but they had 270 crores outstanding with respect to the work already undertaken by them. But they were into arbitration with NHI for recovery of that money. Since they were into arbitration, hence that receivables were still outstanding. Hence, it was a case of a genuine business loss. Since they had filed a case in court, they were fighting an arbitration case. The amount is recoverable from NHI, whereby NHI is itself stating that we have reduced that amount 270 to nil for penalty clause, interest, and all those things. So this is a case of a genuine business loss. But I had given you an example of a rice industry whereby 500 crores were outstanding as a debtors. However, no effective steps have been taken by him to recover such money. That is a case of a intentional business loss. I hope you are able to differentiate between intentional and an unintentional thing. Like I had given you an example in promoter contribution, whereby the funds were round trip from creditors to promoters back into the company. That is an intentional thing. That is an intentional fraud that he was undertaking. Similarly, I told you about whereby a truck was making 130 trips in a day of 50 kilometers. That is an intentional fraud, whereby there was no actual sales. Third thing comes regarding receivables. No effective steps have been taken to recover such money. Suppose debtors are outstanding. Now you have to ask the borrower to prove his intention, that what steps he has taken to recover such money. He should have filed a case in court. He should have sent them legal notices. He should have filed an arbitration. He should have gone into NCLT, whatever the case may be. But he should prove his intention that he is trying to recover such money. He has to prove his intention. Main thing is proving the intention, that what steps he has taken to recover such money. Again, you have to put yourself into the shoes of the borrower to identify whether he has taken any effective legal steps or not. I'll tell you the reason for that. An amendment has been made in CARO 2020. What is the amendment? In case you have given loans to any of the parties, any of the companies, and that loan is outstanding for more than 90 days, and you have not taken any reasonable steps to recover such money, now as a statutory auditor, you have to report that in your CARO. In case no effective steps have been taken to recover such money which have been overdue for over 90 days. This is the amendment that has been made in CARO. Similar amendment, similar thing you have to apply while verifying trade receivables as well. In case the amount is overdue and no effective steps have been taken to recover such money, 100% there is a chance that the trade receivables are fake and nothing is recoverable. It is a clear-cut case of an intentional thing which has been done with a malified intention to undertake fraud as per the definition of fraudulent transactions of RBI. Next point is trade payables. It is similar to trade receivables. Let me tell you, as per the amendment in Schedule 3, now the aging analysis of trade payables is also to be given in 4 parts. Till now, none of the balance sheets, none of the act was asking to provide the the aging analysis of trade payables. But now, as per the amended Schedule 3, you have to provide aging analysis of trade payables as well. What is that? Up to 1 year, 1 to 2, 2 to 3, more than 3. Further, you have to bifurcate the trade receivables, MSME, others, disputed MSME, disputed others. So you have to bifurcate that into 16 parts now, the trade payables. Reviewing accounting policies and practices. While undertaking any forensic audit, you should have a hands-on knowledge of accounting standards that are applicable to that company, let me tell you. If you do not have knowledge of accounting standard, it will be very difficult for you to undertake the audit. I'll give you a practical example of that again. We were doing forensic audit for a company which was one of the top 10 defaulters of India. We were doing audit for one of those companies. One of their companies in the group companies we were doing. We observed company A made sale to company B, B made to C, C to D, D to E, E to F, F to again A. So what was happening? A made sales to B, B to C, C to D, D to E, E to F, and F back to A. Done. It was a circular sales that was doing okay. When all the directors were separate, but when we verified all these 7 companies, we observed that the shareholders were same. All the shareholders were same. What had happened? The company had not disclosed such companies as per accounting standard 18 in their notes to accounts. And 80% of sales purchase were being made from related parties as per the accounting standard 18. In that case, it was a clear-cut case of malified intention whereby intentionally the borrower has not disclosed accounting standard 18 related party transaction in his financial statements, due to which he was availing banking facilities in all the companies from all the banks. And as per the sanction letter, it was clearly mentioned that the drawing power will not be allowed against related parties. It was clearly mentioned in the sanction letter. Hence, he was availing excess drawing power by not disclosing AS18 parties. Second example, AS2 inventory valuation. I'll give you an example that as per notes to accounts, they were valuing as per FIFO, but as per stock statement, they were valuing as per weighted average. So unless and until you have an understanding of AS, accounting standard, AS2, AS10, AS18, AS26, 29, 21, you will not be able to undertake that audit. AS26 regarding intangible asset. In one of the very big case, the main point of contention was valuation of intangible asset. If you study the case study, I'll tell you the case study as well. It was a case study of Kingfisher. They had that bird, the Kingfisher bird. One of the companies valued it at 1800 crores. The other company valued it at 4200 crores. What happened? The bank sanctioned the loan at 4200 crores. So that was a negative part on the part of the banks, that they had sanctioned it under 4200 crores. So unless and until you have knowledge of all the accounting standard, the principles, you will not be able to undertake that audit. Accounting standard 11, accounting standard 13, I'll tell you, investments. There is a concept of a permanent diminution and there is a concept of temporary diminution. So if you have a knowledge of all those things, in that case, you can clearly identify this. Next point is regarding money trail and end use of funds. I guess we don't have much time left. I'll be quicker. We have 15 minutes left. Ascertaining money trail and end use of funds. So while doing forensic audit, you have to make a complete chart of money trail whereby inflow and outflow are completely to be stated. That from where money we are getting and to whom money is being paid. Again, I'll tell you a practical example in this. We were doing forensic audit for one of the companies which was into jewelry. What was happening? It was showing, I will take an example. There were 5 parties. It was showing debtors of around 50 crore rupees. And there was movement in the bank statement as well. There was fund movement in bank statement as well. But when we compared the bank statement, we observed that none of the funds were being received from these 5 debtors. Not even a single penny has been received in last 5 months from these debtors. Rather, the funds were being received only from one party and they were being paid to the creditors. In that case, we clearly classified that account as a fraud. The reason being, all the debtors were overdue for more than 90 days and hence no drawing power should have been allowed against such debtors. No drawing power should have been allowed. This is a perfect case whereby you have to verify the complete trail of funds. The inflow and outflow is to be verified by you. The complete trail is to be verified. You have to check from where the funds have been received and you have to specify to whom the funds have been paid and what is the nature of such parties. They are debtors, creditors, sales, purchase, expenses, fixed assets, advances, loans, whatever the case may be. You have to specify the nature of funds that are being received and paid. You have to verify each and everything. Then points come regarding routing of funds. You have to verify that whether the funds are being routed to consortium member bank accounts. I'll tell you a brief background. It is a lengthy topic. Generally in consortium, what happens? The banks state in their sanction letter that funds are to be routed only through their bank accounts and not through any other bank account. So if your borrower company is operating bank accounts other than the consortium member bank accounts, that will tend amount to diversion of funds. That will be a case of diversion of funds. So you have to verify whether the funds are routed through consortium member bank accounts or other than those. If they are being routed through bank other than those, then it will be classified as a diversion of funds as per the RBI master circular. Next point is regarding physical verification of debtors. As I've told you, you have to physically verify the debtors, whether the funds are properly being routed through, whether the debtors actually exist or not. In that case, you can have a discussion with the bankers as to what parties need to be physically verified, because reason being, you have to incur cost for visiting those debtors. So preferably, you can visit the debtors which are within your state. It is preferable that you visit only those debtors which are within your state. But if the appointing authority asks you to visit all the debtors, in that case, you have to visit all the debtors. Then regarding substantial amount, which does not seems to be an arm's length. This is a scenario whereby the transactions are being undertaken, which are not at arm's length transactions. I'll give you an example for that. We were verifying stock register for one of the companies. and they were selling mobile phones, the mobile accessories and mobile phones. While verifying the stock register, we observed, suppose this mobile phone, OnePlus mobile phone, similar piece, they were selling, what they were doing, they were selling one mobile phone to an unrelated party for 30,000 and to a related party for 12,000. There was a difference of 18,000. When we questioned the management, we asked them why such a difference. They had no reply for that. In that case, the transaction was not being done at arm's length transaction. The reason being, to unrelated party, we were selling it at 30,000 and to a related party, we were selling it at 12,000. Hence, this transaction was not at arm's length. Generally, these type of transactions are for where you can find this. You can find it in purchase sale. That is, you can find it in the stock register. Secondly, you can find it in purchase of fixed assets. These are the scenarios whereby the funds are diverted out of the company, whereby the amount is either overstated or understated. In case of understatement, it means the profit is being transferred to the other company. I given you the example of mobile phone. So 18,000 profit was being transferred to a related party. Had they booked the sale at 30,000, they would have booked 18,000 profit in their own books, but they were booking sales at 12,000. Hence, a profit of 18,000 was being transferred to a related party. Next point comes regarding transactions with sister concern associate group companies. This is regarding transactions which are being done with related parties as per accounting standard 80. You have to check whether proper disclosure are there, whether transactions are being done at arm's length or not. For this, you can refer to the transfer pricing report as well if it is applicable. So for domestic transactions, the transfer pricing is applicable about 20 crores, I guess. So you can verify the transfer pricing reports as well for verifying whether the transactions are being done at arm's length or not. Next point is regarding unsecured loan. For the purpose of unsecured loan, it is similar to the case of your share capital, whereby you have to check the source of contribution of promoter, because promoter contribution can always be in form of two ways only. Either it can be share capital or it can be unsecured loan. So in case of unsecured loan as well, you have to verify the source of contribution of funds. You have to verify that very carefully. What is the source of contribution of such funds? It is to be verified by you, because unsecured loans will be given to you only by a person who is known to you and not by any unrelated party, unless and until you are a very big company. So in case your company is getting unsecured loan, it will be directly or indirectly from a related party only and not from anyone else. So that's why it becomes very important for you to verify the source and contribution of funds. Next and the last point is regarding transactions pertaining to promoters to ensure genuineness or bogus settlement transactions. So in case your company is undertaking transactions with the promoters and the units or related parties, I'll say, you have to check whether in actual such transactions are being undertaken or not, or is this a case of just a bogus transaction? I'll give you an example for that. I was doing forensic audit for a very, very big company, which had 3 factories side by side. There was factory A, factory B, and factory C. All the 3 factories were in separate companies. So there is a company A, company B, and company C. So I was doing forensic audit for company A. So what was happening? The raw material for company A, the finished good for company A was raw material for company B, and the finished goods for company B was raw material for company C. So what was happening? The goods were being transferred from A to B and B to C. They were booking huge amount of sales. However, they were showing debtors of around 250 to 300 crores in each of these companies. And against such debtors, they were claiming drawing power and they were availing bank facilities from the banks. When we asked the management to prove the movement of goods from factory A to factory B, they did not have any documents for movement of goods. They replied me that, sir, since the factories are side by side, we do not need any movement of goods, and the goods are transferred just like that from company A to company B. That the goods are being transferred from company A to company B. In that case, they were not able to prove the movement of goods. On further verification, we observed they were not taking any manufacturing activities. Rather, they were just trading goods from A to B, B to C, and nothing else. And they were showing debtors in all the 3 companies and availing banking facility. This was a case of a bogus transaction that they were doing between the related parties. So if you see this, this is a brief summary of scope of work that is given by the banks. If you will see, it has covered everything. It has covered share capital. It has covered your loans. It has covered your fixed assets. It has covered your investments. It has covered your loan and advances, debtors, stock, everything is covered. So if you undertake such forensic audit, if you're using this scope of work, it can help you doing your statutory audit as well. The reason being about, again, I'll say the amendments that have been made in CARO, it is just like a forensic audit. It is no longer a statutory audit, let me tell you. It is a type of forensic audit that you're doing while doing any statutory audit from March 22 onwards. So you have to be very, very careful while signing any balance sheet. Reason being, let me tell you the reason for that. As soon as the bank classifies the account as fraud and the file goes with CBI, the first person that the government agencies call is the statutory auditor of that company. They do not call the borrower, they do not call the banker, they call the statutory auditor of that company. That what has the statutory auditor done? So in today's scenario, you have to be very careful while signing any balance sheet as a statutory auditor. I hope the scope of forensic audit is clear. So if you have any queries, we can take the queries regarding this forensic audit, or if you have time, 5-10 minutes, then I can discuss the scope of transaction audit as well with you. So if you have any queries, you can unmute yourself and you can ask the queries, or you can send me to it in the chat box. Whether the list of impaneled forensic audit is hosted on IBA website? No, sir. The list is not hosted on the IBA website. You can approach you can approach the banks for the list for that purpose.
Sir, excuse me. Hello.
Yes, sir.
Sir, actually, you are talking about the empanelment earlier, sir.
Yes, sir.
But it requires some kind of previous experience to empanel the firms. How can we get the experience, sir, without having the work allotted earlier from any of them?
Sir, regarding the experience, it nowhere mentions you should have experience from bank or financial institutions. You can have your private company's experience as well, whereby you are doing forensic audit for any private company as well. If you see the eligibility criteria, they are asking for your experience.
Video. Get stuck at into it. Yeah,
Hello.
Hello. Sir, it is not audible, sir. I think power is...
Actually लाइट चलेगी मैंने भी ब्लूटूथ हॉटस्पॉट से कनेक्ट करा सर.
Okay.
तो for the experience purpose, you can do the experience for private companies as well. It nowhere mentioned that it should only be from banks or financial institutions. So if you have any, you can do any type of assignment, like you are doing an HR audit, you can do a debtors audit, you can do an inventory audit for any of the private companies. That is a very good experience letter for you while getting your firm impaneled with IBA.
Even because inventory audit, sir, you mean inventory audit means the stock audits and other things, sir?
Yeah, they are also part of a type of investigation audit only, sir. That is considered as an experience. If you have done stock audit as well, you can attach those letters as well.
Okay. Sir,
yeah.
Tell me, sir.
So even if you are doing, like in income tax, they do special audits. The Bombay Stock Exchange, the SEBI, the RBI, all of them are doing special audit investigation. It is just a matter of nomenclature that is different. It can be forensic audit, investigation audit, stock audit, special audit, whatever the case may be. All are included in your eligibility criteria.
Okay, there is one question from Balarama Prakash, sir. We have applied for empanelment of IBA during July 2021. How will we know whether our firm empaneled or not?
Sir, the IBA has already sent the empanelment letters to the firms. So I have also received the empanelment mail from IBA. So if your firm been empaneled, you must have received the mail from IBA around 2 days back for above 50 crores and below 50 crores both. So if you have not received that mail, it means your firm has not been empaneled by them.
Sir, there is one practical question, sir.
Yeah.
One of the hospital, they have the pharmacy, sir. In that pharmacy, they are purchasing. They are purchasing from various vendor, but it is the stock is not recorded in the books of account, whether they're software or books, nothing is recorded. After 4 or 5 years, they're receiving the party confirmation letter that you have to pay this much of amount like that. But when we verifying it, we don't have a bills, we don't have a stock ledgers, we don't have a nothing. In that, how can we conclude it, sir? How can we quantize the amount of the fraud or something is, how can we quantize, sir?
Sir, the amount, the stock you are saying, it must have been shown in the balance sheet, or it was not recorded in the balance sheet itself?
It is not recorded in the any of the books of the hospital books.
Okay, okay. If it is not recorded and they are making, whether they are making payments to that party?
Yes, sir, they are making the payments. It is through cash only. If it is not paid through bank account, it is paid cash only.
And how are they generating the cash?
Generating the cash?
How are they paying the cash? From where are they getting the cash?
From the sales of pharmacy, sir.
So in that case, you have to check the cash book of that company. In that, you will have to check the inflow and outflow of cash. And ultimately, if they are sending the cash, you can either ask them to physically verify the cash that they're showing in the books of accounts. Let me tell you. So if suppose for an example, the company is showing sales of 1 crore rupees in cash. In case they are showing its utilization, they must be paying to various parties of this 1 crore rupees. So for an example, they paid 50 lakhs in cash to various parties for purchase. But since they are not recording in the books of accounts, the cash will still be appearing at 1 crore rupees. You can easily verify the cash being shown in the books of accounts versus the actual cash that they are showing. You will easily come to know the differences in the cash balances.
Okay, okay. There is another question from CA Sachin Caesar. Sir, is the institute thinking about revision the scope of SA 240? Because understanding the CARO 2020 amendment and as well deliberate by you, the scope of statutory audit seems to expand, and now as an auditor, almost all items of the balance sheet are covered in the CARO 2020 reports.
Sir, the SA 240 that you're talking about is regarding the audit. It is just a basic standard that gives a brief guidelines on how the audit is to be conducted. It does not in any way specify the areas that you have to check. It specifies a brief that you have to verify all those things. But CARO is a specific act that has been issued under MCA by the MCA, Ministry of Corporate Affairs, which specifies various areas that you have to check and you have to certify those things. So SA 240 just tells you about how to audit, but ultimately you had to check these things previously as well, but you were not required to report them. Now you are required to report each and everything in CARO. It is just a matter of reporting. It was your responsibility to verify all those things previously as well, as per the SA 240 as well. But now you have to report and certify those things. This is the major difference that has happened in CARO 2020.
Sir, is there any specific template format for reporting, or we have to make it ourselves? That depends on the case-to-case basis.
It is dependent on case-to-case basis, the industry that you are auditing. Like if you are auditing for a jewelry industry, you have to provide a complete movement in gold rates that is happening. If you are doing it for, suppose for it's a software company, you need not find any rate chart because that is a customized item. If you are doing for an hotel industry, then you have to verify the surroundings areas, what is the occupancy, general occupancy rate around that. So there is no specific format. It depends on the scope of work that is given by the banks. Because in case of EPC contractor, the scope will be separate. In case of a trader, the scope will be separate. In case of a manufacturer, the scope will be separate by the banks.
Okay. Sir, one common question, sir. Sir, whether the forensic audit certification course of ICA is enough, or we have to do some specialized course to gain knowledge and get the certificate and also?
No, if you want to get forensic audits, then first and foremost, you have to do certificate course from ICI. If you want to do further courses, then there is only one course that you can do. It is a certified fraud examiner, CFE, that is done from USA. So that is a topmost course of forensic audit. So if you want to have some theoretical, again, it does not have any practical thing. It is just a theoretical knowledge. So if you want to gain further theoretical knowledge, you can do CFE. There's no other course that you need to do. There are various postgraduate courses and all those things. You are not required to do any other thing. You can do the institute course or you can do the certified fraud examiner's course. That is enough for you. You need not do anything else.
Okay, the insolvency professional experience can be counted for the forensic audit experience, sir.
Yeah, if you are doing transaction audit on behalf of an RP, that will be counted as an experience for forensic audit.
Okay.
So if you are doing transaction audit thing,
in your view, what is the scope for the forensic audit in future, sir, for the next 4 or 5 years?
sir, it is a very, very good future for forensic audit. Let me tell you, reason being, the accounts will ultimately be classified as an NPA. There is no possibility that the accounts won't be, and now they have formed a bad bank as well. By forming bad bank, it is compulsory now before transferring any account to bad bank, they have to classify the account as a fraud or a no fraud account. Reason being, only no fraud accounts can be transferred to bad bank. The fraud accounts will remain with the public sector banks to whom they belong to. So you can classify, it is very important for the account to be classified as a no fraud before transferring it to the bad banks. Hence, in that case, all the banks will want to get forensic audit done so as to transfer those accounts to bad bank in case of no fraud. So forensic audit scope is very much there. But it is dependent on whether you are able to follow with the banks to take that work. Reason being, it has become very competitive now. Reason being, around 400 to 500 firms are impaneled. Hence, and it is done on a bidding basis. It is done on quotation basis. So you have to be very vigilant while undertaking any audit now.
Okay. Sir, there is for initiating the bank forensic audit, there is the limit, sir, 5 crore limit, 10 crore limit, like that?
Earlier there was a limit of 50 crores, but now many of the banks have started undertaking forensic audit below that as well. Currently also there is a limit of 50 crores, but it is the discretion of the banks whether they want to do below 50 or not, but above 50 is compulsory.
Sir, that the limit is fixed by IBA, sir, or RBI? Or...
It is fixed by RBI, not IBA, by RBI.
Okay.
Yeah.
So, sir, normally in RBI, if any frauds happening, it needs to be reported to RBI. If more than 1 crore needs to be reported. So,
yes,
whether the more than 1 crore is need to be after the forensic audit, sir?
Yes, sir. As soon as the account is classified as a fraud, they have to file a monthly report with RBI stating the accounts that have been classified as fraud by them in a specific a monthly return that is being submitted to RBI by the banks. So as soon as the account is classified as a fraud, the report is to be filed with the RBI. Further, in case any fraud is found, now as per the CARO 2020, the ADT4 form is to be filed with the central government in case any fraud is found in the company. So in case any borrower company fraud is observed, one will be filed by the bankers, other will be filed, needs to be filed by the statutory auditor in form ADT4 with the central government.
Okay, thank you. So members, any other question?
Sir, here one query. Actually, one of my client took an immovable property through action from a bank. So it is about 8.5 acres land. After the entire amount was paid to the bank, and when they are going for getting registration in sub-register office, there is some litigation in that property for about 1.5 acres. The adjacent landowner, he claimed that 1.5 acres of his land is within that 8.5 acres. So when my client asked with the banker to clear this issue, the bankers told that it is not aware to them like that. So whether, because that borrower, he intentionally made this property with the bank as collateral security, and through auction it is sold. So whether the person who took that property in action can make a complaint against the bank and that borrower as fraud activity?
No, sir. Actually, when you will see the auction notice, it is clearly written that the property being auctioned are as on where on basis.
Yes, sir. Yes, sir.
And it is the responsibility of the purchaser to check whether the title deed is clear or not.
Okay.
So if you see there is no responsibility of the banks, they clearly state that it is the responsibility of the purchaser who has to verify whether the title deed is clear or not. In case of any further legal dispute, the purchaser will have to fight in the court. He does not have any legal standing against the banks for that. He has to fight against the court because he should have verified that 8.5 acre land with the registrar first. He should have verified whether the title deed is clear, the chain of the documents he should have verified. He should have physically visited the site. Because generally in auction properties, this is what is happening. Either there is some dispute or there is some stay from the High Court that is happening. That's why very less people are very interested in purchasing properties through auction because there is no sanctity. So it is better to purchase a property through NCLT because that the property that you purchase through NCLT is free from any litigation or any dues or demands that may happen. Let me tell you. So it is better to purchase a property through NCLT now rather than purchasing directly through banks in auction. So he does not have any legal sanctity against the banks. He won't be able to win against the banks regarding this. Sir.
Okay, sir. Okay, thank you very much, sir. Thank you.
Yes.
Sir, in addition to that question, sir, the buyer who is taking the auction from the bank is a bona fide purchaser now, sir. Can he get any immunity on that in the Transfer of Property Act as a bona fide purchaser?
No. Sir, bona fide purchaser happens only if he's purchasing from the owner of that property. If you know, in this case, the owner is purchasing it from the person who had the security of that property. He has not purchased it from the purchaser. Rather, he has, even though there were litigations pending. So bona fide purchaser concept will only come into picture when he has directly purchased from the purchaser and purchaser has kept him in dark regarding such litigation. In this case, he has not interacted with the owner of the property, rather he is interacting with the bankers. Hence, in this case, bona fide concept will not be applied.
Okay. Sir, any responsibility or there for a forensic auditor after submitting the report on the...
There is complete responsibility. That's why I was telling that you have to be very careful by the language that you are using in writing the report. I'll tell you this, there are various scenarios that are happening. If you classify the account as a no fraud account and later on the government agencies or anyone finds out that there were frauds being undertaken, you are responsible. In case you classify the account as a fraud and later on it is found that it is a no fraud account, you are responsible. If you classify the account as fraud, your reports will go to all the government agencies and like I am being made witness in around 30-40 cases whereby my statement is being recorded before the government agencies. I will be produced before the court as a witness to justify the evidences on the basis of which I have classified the account as fraud. So doing forensic audit, it looks very creamy thing that you get a good amount of fees, but the amount of responsibility while signing a forensic audit report is huge.
Sir, we have to collect a substantial evidence to document evidence for our forensic audit report, sir.
Yeah, we have to have a conclusive evidence on the basis of which we have given our observations. If we do not have conclusive evidence, then the borrower can file a case against defamation case against you that you have intentionally classified the account as fraud. So you have to have conclusive evidence before writing any of your observations, whether you are classifying it as a fraud or a no fraud account.
Thank you, sir. Sir, Shokmar, sir, can we conclude, sir?
Yes, sir.
Okay. Sir, thank you, sir. Thank you for your the lengthy, neat explanation and clear explanation. It is a wonderful session. I think eye-opener to everyone. So everyone is having the good opportunity in the forensic audit. The same. And also we have a responsibility also. So I think all branches, I request the branches to, it is a new area to every chartered account. So, I request the organizing branches to organize another one session with Rahul Jindal ji for how to prepare the audit report, because it is a new area. So we don't have that much of experience. So with that request, I thank Rahul Jindal ji for his wonderful session. And also I thank each and every member participating in the Panchabootha Conference. And also I thank the for Panchabootha branch chairmen and committee member for giving this opportunity. And also thank you, sir. So thank you, one and all.
Thank you, sir.
Thank you, Arun, sir. So final, the valedictory vote of thanks. On behalf of all Panchabootha branches, I extend my gratitude to guest of honor, Chairman of SIRC of ICI, CA Jalabadi, and Chief Guest CAG Ramaswamy, past President of Institute of Chartered Accountants of India, and CA Kranti Kumar Pati, IAS, Commissioner, City, Tirupur City Corporation, who joined with us and inaugurated this conference. And I thank all the technical session speakers. First technical session speaker, CAG Ramaswamy sir. Second technical session, CA Vishal Podar. Third technical session speaker, CAT Banusekar. And last technical session speaker, CA Rahul Jindal, for immediately accepted our invitation and address our members on the various topics. I thank all the members who registered and joined the conference through virtual mode. And I also extend my sincere thanks to all the Panchabootha branch members who engaged themselves for conducting this conference in a very successful manner. I thank all the 5 branch staff members for the arrangements made by them to conduct this conference through virtual mode. And again, I thank everyone for the successful conduct of this Panchabootha 8th Panchabootha Conference 2021. Thank everyone. Be safe and have a good night. Thank you.
Thanks.